Good morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, Delta missed on earnings and revenue in the first quarter, but it did forecast a better second quarter as it looks to strong summer travel. It also saw its 10th highest cash sales day in its history during the period as passenger volumes exceeded pre-COVID levels for the entirety of its quarter. These results come after American Airlines said this week that its first quarter EPS would likely come in below expectations. The travel industry has faced its fair share of issues over the past year, from worker shortages to some massive technical disruptions. Second thing you need to know, Amazon CEO Andy Jassy is out with his second annual shareholder letter. His message to investors, the e-commerce giant is adapting to a challenging environment. Jassy writes, that's why Amazon reassessed its businesses, eliminating 27,000 jobs over the past year, shuttering some of its physical store concepts, and reorienting its fulfillment center network. Jassy says that Amazon Web Services, the massive cloud business, faces, quote, short-term headwinds right now as companies remain more cautious with their spending. Amazon had its slowest year of growth in its history in 2022 in terms of sales. Its stock lost almost half its value in that period. And the third thing you need to know, Twitter is partnering up with online brokerage company eToro to let users buy and trade stocks on its platform. The new feature will be available through Twitter's Cash Tags feature, which already had allowed users to interact with some financial trading data. Now they can click through to see stock information with the option to invest. The partnership marks a rare deal for Twitter and CEO Elon Musk. He's been making sweeping changes at the company and facing a lot of challenges since he took over last year for $44 billion.
Well, getting back to that first thing, Delta is out with its first quarter earnings. The company missed on the top and bottom lines as it faced uncertainty and volatility over the past few months. I spoke with Delta CEO Ed Bastian about the quarter. He remains optimistic about future travel demand and economic impacts. Take a listen.
The outlook for summer is strong, particularly international. Our consumers are prioritizing spend on premium experiences, and that's our sweet spot. We deliver some of the best experience in the sky, and consumers are wanting to travel. When we look at the second quarter coming up, we're going to have a good performance. We expect an operating margin of about 15%. We expect to grow our top line mid double digits and generate another net $1 billion of free cash. So I'm encouraged by what I see, and we're not seeing any signs of a slowdown, at least on air travel. Remember, we had our recession. We had the worst recession any industry could ever have over the last few years, where our revenues went to basically zero. So our product is one that people need to be accessing for many, many reasons. It's something that consumers are prioritizing, and even to the extent that consumers are deciding to reduce their spend, it's not coming out of travel, or certainly not coming out of the experience economy. You can go to any restaurant, go to any hotel, get on board any aircraft, and you can see that with your own eyes. What I think you're going to see is that it's going to be a pretty strong, steady pull in the latter part of the year.
And so airlines really kicking off this earnings season. And for any investors wondering why the stock is moving higher in reaction to the miss on the top and bottom line compared to what the consensus estimates were from Wall Street and analysts who cover the stock, it is really about what that forecast looks like for summer travel, some of the trends that are remaining intact. I was running some figures, running some calculations based on TSA traveler throughput numbers, and found that during the first quarter, the entirety of the first quarter, passenger volumes, they averaged above pre-pandemic markers for the first time for the entirety of that quarter. About 2.1 million passengers screened every day during the first 3 months of the year. And so you kind of factor in that broader trend that Delta is really looking into, and what Bastian offered even further during our conversation, saying, I think what you're going to see is a multi-year resurgence in travel. It's going to continue, and not seeing anything in the economic outlook that suggests travel is going to be stalled, and really kind of a nod to where consumer spending has been prioritized now among some of those discretionary dollars into services and into that experience economy.
It doesn't seem like demand is the problem, but it does seem like costs could be an issue. And that's really was flagged by American Airlines yesterday, right? That was the issue for American and why it's maybe not going to meet its quarter. It looks like the Delta's costs are going okay. Unit costs are going to be up 1 to 3% in the second quarter. Its non-fuel cost to fly each seat a mile were up by 4.7%. So, I think there's going to continue to be some scrutiny there, even as demand does seem to be holding up.
Yeah.
What is going to happen with costs? We're going to have to continue to watch what happens with pilots and pay. That's going to be a big issue for the airline. So it's not as though it's smooth sailing, so to speak, right?
Right.
Even if demand is strong.
Yeah, and on the pilot front that you were mentioning, he did give a nod to the last couple of years. They've hired between 3,000 and 4,000 pilots, and really the issue there and just getting them onto flight schedules, it just has been training and having enough of the different seats that they can sit pilots into to make sure that they're getting the necessary amount of training prior to being added to routes and flight schedules. And it's important to remember that this is, as well as many of the other airline operators, they're not at pre-pandemic capacity. Even though you're hearing about them cutting some regional routes here and there, it's really more of the negotiations within certain cities and certain hubs that they can get into and get out of, and then kind of trimming where it seems appropriate. But I think in this near-term period of time, especially as we're thinking about Delta 2 and some of those costs, sure, on the pilot front, they had to acknowledge that. We spoke about that. But then additionally, how they maintain some of the costs on the oil front as well, or at least on the fuel, I should say, front, is they have their own refinery operations too that help them mitigate some of the exposure that other airlines have as well.
Right, and they do a lot of hedging.
Right.
Also, all the airlines do for that matter. Yep. Let us turn to Amazon, shall we? In an annual letter to shareholders out this morning, Amazon CEO Andy Jassy is saying that with recent cost-cutting moves, the company remains optimistic about its future. We're seeing the shares not moving much in pre-market. This is really more an issue of it's sort of being interesting what Jassy had to say in that letter versus it being sort of new information. It's more color about the business. And there were several things that stood out to me. One is the commentary that Jassy made about Amazon Web Services. Of course, it's massive cloud business. He did say that that unit is facing short-term headwinds. What I also like, though, is he puts a new spin on cost cutting. He says customers are looking to cost optimize, right? That is something that they are trying to help customers do. And in classic Amazon fashion, they're not necessarily focused on short term. They're focused on longer term, holding on to those customers. It sounds like, if I'm reading between the lines here, even if it means sacrificing some short-term profitability. If I'm reading that correctly, he says our AWS sales and support teams are spending much of their time helping customers optimize their AWS spend so they can better weather this uncertain economy. And so, maybe that's an indicator of more of what we could hear on that front.
The read through for me on this, and even with what you had mentioned in kind of the growth that they're talking about in the AWS side, and even some of the slowing of that growth perhaps, that they're still trying to sell other elements of their business as a broader Amazon growth story here, which is remarkable when you think about the vast size and scale that a company like Amazon is and the tentacles that it has into both the corporate constructs and the cost structures there, but also into every single household essentially as well in one form or another in the purchasing of anything from groceries all the way into the e-commerce side. They said that they have a consumer business $434 billion worth in 2022. And the vast majority of total market share in global retail still residing in physical stores, roughly 80% they say. So painting that as a growth story. They also paint machine learning and generative AI as a growth story as well, talking about large language models, the LLMs that we have increasingly discussed as every single seemingly technology company has had to decide one way or another how they're going to market themselves or position themselves around AI. And so where that will play into AWS going to be interesting and perhaps add to that growth story that they're trying to sell, but also even up into space. I think about a company that we've been tracking, of course, because of some of the demise and the bankruptcy that has moved forward in Virgin Orbit. and particularly where Amazon now is perhaps going to try and take some share there where possible. Of course, Blue Origin, one of Jeff Bezos's other children, of course, Jeff Bezos not the CEO of Amazon anymore, but still as the founder, there is a lot of kind of overlap or at least synergies between the two ideas that he has and how that can come together, where that can be beneficiary for Amazon. And I couldn't help but look at the shares of Vorb this morning, even as Amazon within this annual letter was talking about its own innovation for customers in low Earth orbit satellite systems. And Amazon is a communication services company. Is that what we could potentially see them delving further into with an initiative like this as well?
A grocer, they're a healthcare company. Why not? Also
not?
a space company. One more thing I want to mention from the letter, and that's what Andy Jassy has to say about the future of work, where he really doubles down on being in person at the office, talks about the value of the water cooler effectively, right? Being in person, being at a whiteboard, being able to brainstorm with colleagues. He talks about serendipity, which is always the word I zero in on when I'm talking about in-person work, where you just meet somebody by chance in the hallway, you chat, and then an idea springs from that, which is just not something that naturally happens when you work remotely. And it just emphasizes once again the real tumult that has occurred in lots of different white-collar workplaces, but particularly in tech, when you've had these employers say to their employees, you don't need to come in. The people have scattered to the winds, and now they're calling them back to the office. In some places, they've scattered to the winds, and then the job has been cut. Right. And then the person is now located in, Kansas City, North Carolina, Montana, wherever, where there's not that tech industry, and they're wanted back in person. And so, you know, you could say, oh, these poor people, but like it really has created a lot of disruptions in people's lives. So it is interesting that he becomes the latest CEO to really emphasize that value of in-person work. Right,
especially as the broader tech industry had really been the sector to promote so much of the work from home or work anywhere or be virtual, because if we are tech first, then we need to be emblematic. We need to showcase exactly what the power of our collaboration tools and suites are. So yeah, you can be out there, be anywhere in fact, but, until May of this year.
Until not.
Yeah. Also everyone, switching gears here, we got to talk about Twitter. Twitter's more than 350 million users can now trade stocks and crypto on the app thanks to a new partnership with online brokerage company eToro. This is starting today, and Twitter's existing cash tags feature will now include real-time data on assets including stocks and crypto. And now, when viewing a ticker, users can click through directly to eToro to buy or sell shares. eToro's CEO says that Twitter's new focus on finance is exciting, telling CNBC they hope to see eToro's partnership with Twitter expand. This after Twitter was merged into X Corp earlier this week, the latest move in Musk's plan to develop what he's calling an everything app. We're going to speak with Callie Cox, investment analyst from eToro, in our 11 a.m. hour. You do not want to miss that.
Well, Warren Buffett making headlines not for buying a new stock or upping his stake in a company, but instead for his endorsement of Fed Chair Jerome Powell. In an interview with CNBC, the CEO and chairman of Berkshire Hathaway praised the job that Powell and company did throughout the pandemic, saying that had Powell not been leading the Fed in March of 2020, the U.S. economy, quote, could have gone very different. He added he doesn't think he would do as good a job as Powell had done. The backdrop for this, by the way, is that yesterday we got Fed minutes. We had some Fed officials talking about a potential recession. We also, by the way, got producer prices this morning that showed a drop on both the top line and the core numbers. So interesting there as we talk about the outlook for the Fed.
That's right. And I mean, thinking through how many of the different major kind of heads of investment, or at least in the broader equity market scene, we think about how many of them have been calling for Fed Chair Jay Powell to continuously look at more forward-looking data. And of course, the Fed has to get through some of the existing economic data that is on a lagging basis, but at the same time gives them perhaps the best reading, or historically so has given them the best reading on where their policy is beginning to set in over time as well. And so with that, we do know that Warren Buffett approves and believes in Fed Chair Jerome Powell. Let's bring in our next guest for her view on the central banks. Joining us now, we've got Ellen Hazen, who is the FL Putnam Chief Market Strategist. Great to have you here with us, Ellen. First and foremost, this vote of confidence that we're seeing now from Warren Buffett into Powell, does it come by surprise to you or at all, or is this largely expected?
I was glad to hear him say that he approves of the job that Powell has been doing and it is doing. So that's a real vote of confidence in the market. One of the other things that I thought was really interesting about his comments yesterday was talking about how U.S. depositors will be safe and that the FDIC is paid for by the banks. So even if depositors get bailed out in certain areas, like with Signature in Silicon Valley, it's not going to be a risk to U.S. depositors. I think that message came through loud and clear in his comments, along with the praise of Jay Powell. So I think that Warren Buffett is a very smart man. He's seen an awful lot of central bankers come and go. And I think he's absolutely right about this one.
And so, there has been, though, a lot of discussion and debate about Fed credibility, right, Ellen? And so I'm curious how you're thinking about that issue from here. I mean, in other words, I heard some commentary yesterday when people are looking at the minutes and the Fed is talking about a recession. Well, that their forecast is not necessarily worth very much, although obviously they're the central bank of the United States. What's your view?
I think economists, like all forecasters, can have biases and can have blind spots. And I think that they are not always right. And so certainly in our business of investing, if you hit 600 or if you're right 60% of the time, that's a very good year. And I think that the same can be said for economists and for the Fed economists in particular. So whether or not the Fed staff is correct that there will be a recession later this year, I don't know. But I do agree with something else that Warren Buffett said in response to this, which is that Berkshire's not changing what they do depending on whether or not there's a recession. They're looking at the fundamentals of the business. And that's exactly what we do in investing too, right? We can't know if there's going to be a recession, but what we can do is find companies that are going to do pretty well regardless of whether or not there is a recession. And that's a key distinction, right? We can't control what is going to happen. We can only control what we do. As far as the Fed's credibility, I think the Fed has been very, very clear that they want to see inflation come back down toward their 2% target, and we're still at 5% plus. So it's going to be very difficult for them to start pivoting anytime soon unless we see that inflation number really nosedive. And even though it may cause the economy to be weaker than it would otherwise have been, I think they've got to stay the course. I think they know that they lost a lot of credibility by being so late to raising rates and by being so late to recognize that inflation was going to be non-transitory. And I don't think that they are going to, I don't think they're going to pivot as quickly as the market seems to think they are.
From a portfolio strategy perspective, where are the best places to be in the market as the Fed continues on their own policy pathway?
So we're cautious on areas that are going to be negatively exposed to higher rates. So we all saw what happened with some of the regional banks. But there are other areas also negatively exposed to higher real rates, including autos, including housing. So we're cautious on those. And we're looking for companies that are steady eddies, that provide high cash flow generation, that pay a nice dividend, and that are going to do okay regardless of the economic environment. So you can look at areas like healthcare and drug distributors in particular. You can look at certain industrial companies that are less market sensitive. You can look at payroll processors, a lot of things that are going to be relatively less sensitive to the economy so that whether or not there's a recession, they're going to do okay in a slowdown.
And what about turning back to Warren Buffett for a minute and his sort of value slant, if you will? It sounds like you're sort of in the same camp when I hear you talk about things like healthcare, for example.
Well, as I said, very smart man. Happy to be compared to him in any way whatsoever. Certainly, we all learned this in our CFA programs. Stocks are worth the present value of their future cash flows, right? Now, in some markets, that doesn't always come true as quickly as you think it should. But in the medium to long term, it does come true. And so for us, that is our true north, is how much cash are these companies going to generate and what are we paying in order to be the recipients of that cash flow? So I think that sometimes value is in vogue, sometimes growth is in vogue. Certainly the first part of this year, growth has come roaring back with a vengeance after being crushed last year. But if you wait out all that noise and you just look for companies that are generating a lot of cash, then over the long term, you're going to do well. You're going to meet your financial goals.
And finally, Ellen, one single pick that stands out to me is Schwab. And that's just because there's been a lot of scrutiny of the company in the wake of the sort of mini banking crisis, if you will. Why do you step in there at this point? And is that a vote of confidence on your part in Schwab?
That's a great question. Schwab is trading at half of its normal multiple. And so one way to interpret that is that the bank is essentially worth nothing. They have more than enough liquidity to meet any deposit withdrawals that could happen. The vast majority of their deposits are insured, so they're below that FDIC limit. So that is a big difference from some of the banks that failed earlier in March. And as we look at it, Schwab dominates the custodial business. They're the largest broker, certainly the largest publicly traded retail broker for U.S. clients. They're very conservatively managed, and it is true that they have a big held to maturity book, the same as some of the banks, but they have more than enough liquidity in terms of credit lines, and most of their deposits are insured. So if you look at the punishment the stock has taken, it's really disproportionate to what we think the most likely outcome is. And when you compare the upside to what the possible downside is, we think it's pretty attractive.
Ellen, good to see you. Ellen Hazen, FL Putnam Chief Market Strategist. Thank you.
Thank you.
Coming up, Rent the Runway shares sinking in pre-market despite hitting a record subscriber count. We will explain, and we'll have the opening bell next. Coming up on the opening bell, let's take a look at some movers. Alibaba shares, they took a hit after the Financial Times reported that Japan's SoftBank moved to sell almost all of its remaining stake in the Chinese tech giant, but then they rebounded. So kind of an interesting situation here, Brad, because you would think when a big shareholder sells a stake, even if it maybe wasn't a complete shock, that still it would be weighing on the shares. You see here, it's really been a very gradual wind down from a very large stake that SoftBank had in Alibaba of as much as 34% at the peak. Now, according to the Financial Times, that stake's going to go to 3.8%. SoftBank has had some troubles here, and it's been winding down a lot of holdings. Right. So maybe it's because people are seeing it more as a referendum on SoftBank than on Alibaba. I don't know. Yeah,
I think so. And even as we think about what Alibaba has had to go through in its own contentious relationship with China and the broader kind of tech landscape within China has, over the past 2 years, run into regulatory issues with the nation. And so with that in mind, it had been under pressure for basically the past 2 years, even outside of the broader tech downturn that we had seen last year. And so with that in mind, I think for Alibaba and this relationship with SoftBank, and even as SoftBank has sputtered on some of its own vision funds that they have been able to put together and amass billions of dollars essentially, but has not necessarily seen the returns that some of the investors had looked for within that, this could be a broader referendum that not only is seen on SoftBank, but SoftBank perhaps just needing to liquidate some of its positions as well for operational perspective.
Yeah, and Masa-san has said, the head of SoftBank has said he is focused now on the eventual listing of ARM. That is the big semi company that SoftBank took over in 2016. And so part of this presumably is to help fund that whole process. So that's something to keep in mind as well. The timing of this is also interesting. Alibaba just announcing it's going to do that split right into 6 different parts.
Right. Yeah.
And so maybe SoftBank judging that this is the time before that gets completed to wind this down even further.
And not knowing what type of valuation each of those businesses as a split entity would carry as well, or which maybe they pick and choose. Maybe they come back into Alibaba in some facets as the split becomes kind of more clear as to when all of the components begin trading, but then additionally, what type of revenue base each of those as a separate entity and the type of data that each of them will have access to as well. I think that'll be a key decision in terms of any investor that's looking to get into one individual portion of a split Alibaba business, SoftBank included on that, if they were to pick and choose, put together their own basket of holdings of the split Alibaba entities. Also here, we're tracking one motorcycle company that is very near and dear to many people's driveways, perhaps. Harley-Davidson slid following the announcement of a C-suite shakeup. Chief Financial Officer Gina Getter is going to step down at the end of April to pursue an opportunity outside of the company with toy maker Hasbro. Far different company there, but I guess,
Toys of a different kind.
Toys of a different kind.
I think you could say.
Yes,
right?
More cost-efficient toys, cost-effective, cost-optimized.
Yeah, I guess quantity there, perhaps over the single bike in the driveway.
Right.
And it looks like David Viney, who's the treasurer, is going to be interim CEO once she leaves the company. But it looks like investors are not super pleased about this as we see a bit of a sell-off in the shares. The shares have not done well, by the way. They are down 28% since their near-term peak back in February. So it's interesting that this transition is now happening. It doesn't seem like it's anything like fundamental at the company. It sounds like she got another job, but nonetheless, she'd only been there for a few years.
Well, even the tone at Harley-Davidson had really been around what they're calling a transformational journey. If anyone listened into that earnings call, you probably would have gotten this vibe that, they're still monitoring what the economic environment looks like. They're saying that continues to evolve, yet still optimistic on specific potential of Harley-Davidson's businesses. And it comes as they're looking across some of these strategic pillars. They defined 6 of them. I won't go into all of them, but just think specifically around their touring, their large cruiser, and their trike. Those are the segments that are most profitable, and they continue to really pound the pavement on that. And so expect to hear more about what are the most profitable parts of Harley-Davidson, as well as where they still have the relationship with Livewire, of course, that spinoff that they were able to take public, but still own the lion's share of at the end of the day, and are able to benefit from how well Livewire does. But I mean, it's still an expensive product that they're putting in the market.
Yeah, you know what? I just spotted some analyst commentary on HOG that I thought was quite interesting from UBS. The analyst over there is Robin Farley, and he's predicting that retail sales at U.S. dealers of Harley-Davidson's could be down close to 20% for the first quarter. And he talks about that this is even with Harley offering fairly low financing costs for people who are wanting to buy the bikes. UBS says March did have an easier comp versus last year, but still doesn't look great. And the analyst there has a neutral rating on the stock. So that certainly can't be helping sentiment, that kind of a prediction. Just checking to see when Harley is out with its full numbers. It looks like later in the month, around April 27th is when it's due.
All right, much more about the hogs on the road at that point in time.
And whether we get confirmation of that lousy prediction, we shall see. We got the opening bell on Wall Street coming up in just a moment. We had producer prices falling this morning. People still digesting the Fed minutes from yesterday. So let's see how it all shakes out as trading begins here this morning. There you see FS Investments ringing the opening bell on the New York Stock Exchange here this morning. You know, when you have the Fed saying that, yes, there could indeed be a recession, on the flip side, when you have producer prices that came in with declines, which is quite interesting here in this environment, even as consumer prices continue to rise, but does suggest that some of those input costs for companies are mitigating. PPI final demand down 0.5% month over month, excluding food and energy, down 0.1%. So that's seeming to be maybe a positive for stocks, perhaps, as we see all three major averages in the green for now. Not runaway gains, Brad, but still a little bit green.
Yeah, a little bit of green here on the day as we're taking a look at the Dow Jones Industrial Average. You're seeing that up by about 0.1% to kick things off. Adds on to the net gains that we've seen over the course of this week. We are up over the past 4 days by about 0.6%. Nasdaq Composite up 0.6% out of the gate here today. However, over the past 4 days, net lower as we've seen some sputtering in the tech sector over the course of this week. As of right now, for the aggregate, it's down by about 0.7% over the course of this week. The S&P 500, you're seeing that just about as flat as it gets, barely to the downside for this week. However, here today out of the gate higher by about 0.3%. Also want to take a look further at the S&P 500, dig into some of that sector activity here. 11 S&P 500 sectors, we've got them pulled up on the screen for you here. Utilities is the laggard right now by about 0.7%, the largest laggard, as we are relatively split, about as split as you can get for 11 sectors there. But ultimately, communication services, you're seeing that move higher by about 1% out of the gate this morning. Also, interesting activity that you're seeing in consumer discretionary. That's up by about 0.8% as well. Also, just want to take a brief look at the Nasdaq 100. We'll give you a glimpse at some of the mega cap tech stocks after we got that Amazon annual letter, the CEO letter from Andy Jassy this morning. You're seeing shares higher there by about 1.4% for AMZN. Also taking a look at some of those other mega cap tech stocks, you've got Apple up 1%, Microsoft higher, but just by about 0.1%. Alphabet, Google, whatever you're calling them, call them up by about 1.75% as well. And then additionally here, just want to zoom out and take a look at the Dow 30 components here, and largely in positive territory, but you still do have some laggards in the form of interesting Big Blue pulling up the caboose. I tried to make it work. It's down by about 1.2% right now.
Yeah, it was a report from the Wall Street Journal that IBM is looking to sell it. Perhaps its weather business could be worth as much as $1 billion, but that's not helping the stock, interestingly. And it's not a done deal. It's just something that it is reportedly exploring. So we'll keep an eye on that. Another thing we're keeping an eye on is Rent the Runway. It beat analyst estimates on the top and bottom line. The company continues to try for profitability. The forecast not looking so fantastic, though, and the shares are down by about 1% here today. The company said that for the first quarter, it is looking for revenue of up to $74 million. Analysts have been looking for a little bit more than that. And speaking of CFO transitions, the CFO of the company is going to be leaving her role as of May. Sid Thacker, who's a senior vice president there, is going to be the incoming CFO. Analysts seem fairly positive on certain things for the company. As I frequently talk about, I am a Rent the Runway customer.
I'm jealous.
Yeah, they should come. They should come with some men's stuff, right?
For select items.
So they have recently beefed up their subscription plans. What they have dubbed in marketing the era of extra. They give you extra items in every shipment. So it sounds like, according to analysts, that has shown some progress. I mean, I'm a fan. I pay the same and I get more stuff So
It's
that's
interesting.
not a bad thing.
It's like we thought you might like this type of play on top of it.
Kind of.
Yeah.
Yeah, indeed.
Well, it's perhaps adding to some of those active subscribers, or at least the maintenance of the active subscriber base for the quarter. That rose 10% year over year to 126,712. It still was shy of some of Wall Street's estimates, we should note, but the loss, the fourth quarter loss was able to narrow as well. That came into 40 cents a share as well, but still that is good compared to the 62-cent loss that was expected by analysts there as well.
Yeah.
So,
There's
one day maybe I'll be able to get another runway subscription.
You have to reach out to Jennifer Hyman, the CEO. No relation.
Dang.
Sorry.
If there
Sorry,
was,
don't have it in there.
I thought I would have a direct line of communication in. Not today. All right, guys. Coming up, LVMH is showing positive signs for the luxury market after the Chinese shoppers drove a surge in sales. We've got the details next. Let's talk about the luxury space. LVMH reporting strong earnings results, highlighting that wealthy shoppers are not scaling back on spending at all, and the company reported a record-setting year that helped CEO Bernard Arnault briefly grab the top slot on Forbes' list of billionaires. You're taking a look at shares. They are reacting positively here on the day. They're higher by about 4.7%.
I think they're at a record.
New record for them. All right. Well, that's on the back of some growth across major business groups there. You saw growth come in the most across selective retailing there, followed by fashion and leather goods. Those leather goods, people really trying to get into those for the summer. Going to be a little sweaty, hate to let you know. But wines and spirits.
It's also handbags. It's not just stuff that you wear.
Okay, all right. I don't know. Maybe it's just the rocker in me.
You just want, let's go back to Hog for a minute. Yeah. You strap on your leathers and then you get on your bike.
Right, you gotta have your leather jacket.
Yeah, you need that protection.
Net positive for LVMH.
Yeah, there you go. But let's talk about geographies too, because Japan did well for them, Asia did well for them. One area that did not do as well for them was actually the United States, which saw sales growth of 8%. Most of the other regions, though, saw double-digit growth. So that's interesting. And the CFO of the company talking about that it was actually cognac that was weaker in the U.S. and that was an issue. And then he talked about that it tends to be cyclical, the U.S. cognac market, apparently, which is quite interesting. Something else that we should keep an eye on as well is, remember LVMH, old habits die hard, LVMH. LVMH is in the process of buying Tiffany, or bought Tiffany, I should say, and the flagship store in New York of Tiffany is going to reopen at the end of the month, according to some reports that I've seen that cite that CFO, and that it contributed almost 10% of total Tiffany sales when Tiffany was an independent company, which is pretty astonishing here. It is sort of a tourist destination, if you will.
There's really a lot of interesting tidbits to pull out of this. I hadn't seen the cognac mentioned there that you had brought up. They got to give Shannon Sharp a call, perhaps, with that Le Portier cognac. Club Shay Shay. Just shout out there for you. All right, guys, coming up, the Biden administration is ramping up its EV push, but our next guest is outlining several bottlenecks that the U.S. could face. We'll discuss next. It's time now for our chart of the day, and today we're looking at global EV production, which increased by 74% in 2022. Analysts at Bank of America are predicting an EV penetration rate of 42% by 2030, meaning it will be an uphill battle for the automakers as competition heats up. A few things on this front, even as you're looking at the global EV sales and the regionality and approach there, is it's going to come down to where there are production mandates as well that actually spurs some of that production. And then you think more on a competitive front of the different parts, the materials, whether that's a rush for lithium resources that we've heard Tesla as well as the other major automakers and legacy automakers talk about, or just trying to compete on the power of the battery as well, which all of them are already creating their own competitive positioning around.
Right. So there's this sort of tension, perhaps. There's sort of three different ports of tension. There are regulators who are pushing for this, not just in the U.S., but around the globe. There are consumers who, in some cases, don't want this, in some cases do want this. And then there is the supply chain and the technology and the innovation and the ability to your point, make the cars or the vehicles of all kinds that could meet the demand that the regulators would like to see.
Right, and the regulators are also going to have to grapple with how quickly infrastructure is brought online to make sure that it is a compelling play. In order for consumers to see the value in holding and owning an electric vehicle, there's going to need to be more gas stations that essentially have the ability to charge their vehicle. Right. And so building out the network that much more quickly is going to be critical and paramount to even the messaging that they're able to put forward in the marketing of a lot of the vehicles as well.
Yeah, so there's a lot that needs to happen, in other words. And as the Biden administration hits the accelerator on its push into EVs with those new electric vehicle tax rules set to be unveiled on April 18th, we want to look at possible bottlenecks that we just touched upon. Bank of America's head of metals research, Michael Widmer, joins us right now. And Michael, I feel like this is an aspect of the story that is not talked about enough. That is, there is this huge push, but do we have enough metals to make all of these electric vehicles when we talk about components that are unique to EVs? Do we have enough?
Well, the question is, do we have enough metal to get the energy transition overall done, including the EVs? And I think that's where we have our doubts at the moment. We don't, I think. And it all comes down to a lack of capital expenditure. I think when you're looking at the metals and mining industry, we had peak capex in 2012. Right now, we're spending about half of what we should spend to prevent constraints or bottlenecks from a raw material side on the way to net zero. Net zero at the moment, as it stands, is not achievable with the metals that we are actually taking out of the ground.
Okay, and so it's going to come down to the natural resources, the elements that they can get. Where is the kind of, as more of them are saying, even in Tesla's earnings call, as I think back to that, all about lithium, which is the most contracted or most precious type of raw material that all of them need to vie for right now?
So if you're looking at that's the interesting bit, and I think we're talking a little bit about the report that we published on that. We need more system integration. You can't just look at one commodity in our view. You just have to look at the entire ecosystem that you effectively have to build. So for an EV, for instance, right now, the key technology is a lithium-ion battery. Without that, it would be very hard to put more EVs on the road. But then again, once you put the lithium-ion battery in, you have to wire up the electric vehicle. For that, you need copper, and you need to build the transmission and the distribution line. So that you need copper as well. So that's another bottleneck that we potentially see affecting this sector. So we're not saying that you can't do it, but we need to see more investment in the space to facilitate all of the growth that we would like to see to mitigate the impact of climate change effectively.
Do you see any fluctuation in the prices of lithium and what they're able to contract for that's also going to be passed through to the consumer and impact the ability for them to say, and them, the automakers, to say that, yeah, we have a mass market type of cost that we're able to roll out to the broader public?
Look, I give you a very concrete example. There is one of the major lithium producers out there. They expect an 800,000 ton lithium deficit by 2030. That's about a third of supply. Then you run that through your normal model. That would effectively justify a lithium price of somewhere around $150,000 per ton. That means that you would make an electric vehicle $3,000 more expensive compared to where it is right now. So something ultimately has to give. If you have the shortages, lithium just rallied 1,100%, by the way, just to say that. Prices coming down a little bit now, but if you have got the shortages, raw materials will get more expensive. Raw material price volatility will pick up, and that makes it harder in a way to deliver the volumes that you want. So it's not just the tons that you potentially don't have. It's also everything that comes with it that potentially impacts on the progress with making the economy greener.
So when you talk about the lack of investment in the space, is cost the primary reason, the primary thing that is holding it back?
Cost is potentially one of the issues. So we have seen cost inflation coming through. But if you're looking at a lithium refinery, for instance, a lithium refinery built in China can run potentially at $10,000, $15,000 per ton. A lithium refinery in parts of the Western world probably looks at more like $20,000, $25,000 per ton of operating costs, or reinvestment costs. So it is actually a little bit more expensive. It's a little bit more expensive there. But no, I think one of the key issues that we have is a very mundane one. I think when you're looking at the last 10 years, miners had over-invested in capacity during the Chinese bull market, and then were almost forced by the market to reduce that capex. I think there was also not a lot of focus from the kind of global community that we actually do need basic materials, and that's kind of what is coming back to haunt us at the moment. And it's unfortunate, but you can't just flick a switch and bring more metals to the market. Some of the copper mines that are starting up at the moment have been developed 25 years ago. The best you can potentially do with developing a new mine is kind of doing it within 8 years from the construction side. So there's a whole lot of issues that coming together. But the bottom line, just bringing it back to one thing, for a lot of the commodities, we are just not sinking enough money into the ground at the moment.
Michael, when we think about the charging infrastructure that we were talking about a moment ago as well, is there a metal or a resource that is most important, or a material that is most important for the building out of the charging infrastructure?
Yes. So the charging infrastructure is one thing, but I think the entire grid infrastructure is another important thing. And I give you a very concrete example of what I mean, of the implications of that. Take China, for instance, last year. China's housing market did very poorly last year. So take copper. Copper is a key commodity, is one of the key commodities that we require in housing. Housing made a negative 10 percentage point contribution to copper demand, but that was completely offset by spending from EV manufacturers and the grid companies in China, which made a positive 15 percentage point contribution to copper demand out there. So in a year where the Chinese economy was positioned very poorly and very patchy, that spending in the grid, in EVs, actually completely offset the weakness that we did see in some of the more traditional sectors. So copper, and that's what we learned last year, is one of the most exposed commodities to that decarbonization of the global economy. And that's just China doing it. Now we have got accelerations in Europe and the US coming through as well, trying to put more EVs on the road, build out the grid and the charging infrastructure.
So when all is said and done, fast forward to 2030, which is effectively what you do in your report, what does the dynamic look like for EVs? Do we have this investment in some of these commodities that sort of has normalized and the pricing is rationalized, or do you think that there's still going to be this imbalance?
No, I think there's a whole lot of things that will happen. I think we potentially get an acceleration in capex. We will almost certainly put more EVs on the road. The question is just what numbers we will be able to ultimately accomplish. We might see some changes in technology. We see dynamics now that suggest we get less lithium-ion batteries in cars and now more sodium-ion batteries. So it's a very dynamic system. But I think a lot of those adjustments will ultimately play out, firstly, over higher raw material price volatility, and secondly, over higher raw material prices.
Michael, thanks for joining us. Michael Widmer, really interesting stuff. Bank of America head of metals research on an important topic that, as I said, we do not talk enough about. Thanks, Michael.
Thank you.
Coming up, grocery prices fell for the first time since September 2020, but it might not last. Brooke DePalma is going to bring us some of that bummer of a news next. Grocery prices declined in March, falling for the first time since September 2020, but one expert says don't expect that to last for some food items. Yahoo Finance Brooke DePalma joins us with the details. As I said, a little bit of a bummer, right? Because we were happy to see some of those pullbacks in prices.
Very happy to see a pullback in prices, but California's wet weather causing massive flooding. One of the largest areas that are impacted is the Salinas Valley. Now that produces nearly 80% of our table veggies, and right now about 10% of the Salinas Valley acreage is still underwater. So what that's doing is delaying spring planting season, meaning bad news for farmers here and bad news for prices when at the store for consumers. So Wells Fargo Director of Agriculture said that he expects common household produces to go higher in prices because of this delay. Now, items that will be impacted the most, or ones that you should keep a lookout in terms of just how high they can go, is processing tomatoes. So think pasta sauce, think pizza sauce here. He said that he expects prices to go up because they just simply cannot plant enough processing tomatoes this year. He said his advice to consumers is to look out for deals when you can find them. Now, as you can see on the screen right there, tree nuts, think pistachios, think almonds, those will also be impacted. He said his team is monitoring them very closely over the next few months. Those harvesting season is August and September, and so then we'll get a better idea of just how high prices can go. But he said that weather back in February actually significantly decreased the amount of hours that are required for trees to pollinate with bee activity. And so he said that could lead to a tight supply, which ultimately could drive prices higher. Now, Brad and Julie, one thing that could even impact this even further is if those California snowpacks melt too fast, that could lead to catastrophic flooding, he says, which could ultimately lead to tighter supply and even higher prices at the store.
So are there items that won't be impacted on the other side of that?
Yeah, well, fingers crossed that it'll still be a good, fruitful season across the board. But items that he said that are persistent, that may not see as much of impact, is citrus fruit, oranges. He said that those trees are quite persistent there. He said that we should not expect a supply issue there. Of course, earlier this year, we had a close eye on California oranges as citrus greening disease took a toll on the crop there. Another item that we're keeping a close eye on is grapes. He actually said that because of all this water, it's actually putting the salt lower into the soil. It's great for the soil, and ultimately that could lead to a good harvesting season later on. That's about August through October. It's a late harvesting season, and so this can mean good news for vineyards that we see many of in Northern California. And it's a different story than what we've heard in years past. Of course, wildfires have taken a toll on California agriculture, and so a different issue here. Of course, the water is welcomed here. It's exciting news for farmers, but this flooding is certainly taking a toll as well.
Time to fire up the backyard gardens.
Right,
Oh, yeah.
right, and that's a lot of comments on my story on Yahoo Finances that people are saying that they're going to plant this season, that they're going to go in their backyard just to combat inflation and ultimately get maybe their produce for a lower price there.
All right. I'm going to start gardening.
Yeah, you can put a little window box.
Little window
Do a
box.
little
some
window
fresh
box. You can do a
basil.
little indoor hydroponic one.
Ooh.
Right?
Yes.
That's hot. The young
A little
kids.
vertical farming
Little
situation.
vertical farming, yeah.
Oh my
Got a
God!
green
Certainly
thumb.
working around inflation here.
Done deal. Brooke DePalma giving us
you.
all the answers on how to work around inflation. Thanks so much. We appreciate it, Brooke. Also coming up, everyone, investors are gearing up for earnings season with big banks. Well, they wanted to kick off results tomorrow, but the airlines kind of beat them to it. We're going to break down what you should be watching, though, when they do report. That's coming up next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman along with Brad Smith, and let's take a look at the latest market action. Investors, of course, bracing for crucial bank earnings, and they're watching a lot of other things. So besides that, in anticipation, we're not seeing a heck of a lot of movement in the markets here today as we try and refresh here. But if we're looking at the markets here, I also want to take a look at commodities here today. We've been keeping a close eye on oil prices recently. I was just trying to reboot things up here to get everything moving a little more smoothly. There we go. I want to take a look at what's going on with oil prices here today, because we did have OPEC out with a new demand forecast here, and talking about that the demand for oil is going to continue to be robust this year. It is at odds a little bit with recent decisions and announcements by OPEC nations to cut production at the same time that we see demand expanding. What does that suggest? Well, it could suggest that there is more upside for oil prices after some of the recent declines that we have seen for oil prices. Now, oil is not rising today. However, that is what folks who are watching these predictions are starting to talk about, a potential rebound. And already we have seen oil prices, of course, rebound from the low. So that is something that I'm keeping an eye on today. As we look at how all of that is percolating through to some of the sectors within the S&P 500. We've got energy as a group, not much changed here today. Communications services in the driver's seat, up about 1.4%. Industrials down about 1%. And if we translate that to some of the Nasdaq movers here, you see why communication services as a group is higher. It's because their components are higher. Meta shares up about 2.25% here today. We've got the likes of Amazon, Apple, Microsoft, and Google also on the rise. So all of that helping matters, Brad.
All right. Well, also hoping to help matters in the course of the conversation in the markets this week. Bank earnings kick off this week, where we'll get a better picture on the impact of the banking turmoils from March. JP Morgan among the big names posting their quarterly results tomorrow. Chief Executive Jamie Dimon already warning in a letter to shareholders earlier this month on the banking crisis and the, quote, repercussions from it for years to come, end quote. So how will banks hold up compared to Wall Street expectations? Here to discuss this and more, we've got Puck News founding partner Bill Cohen, along with Gillian Tett, chair of the U.S. editorial board and editor-at-large of the Financial Times. Great to have you both here with us this morning. William, I want to begin with you this morning, actually. Bank profits, what are you expecting from some of the Wall Street banks as they report? And ultimately, is this going to be a rosy scenario that they're trying to paint a picture of? Or is there something else that's in the play or at work?
Well, Brad, obviously it was a tough quarter in the banking sector generally, but I think for the big Wall Street banks, because of this so-called flight to quality that occurred as some of the regional banks either were liquidated or stumbled and had to be rescued by the FDIC, I think that the big banks are probably going to be fine. Jamie Dimon once told me that basically 80% of their revenue and profits in any given quarter are pretty much locked in. And so the 20% is variable. Obviously, investment banking has had a tough quarter. There hasn't been a lot of investment banking underwriting, IPOs, M&A deals. So the bread and butter in investment banking had a tough quarter. Trading probably had a good quarter given all the volatility. And the rest of the bank, I'm sure, is doing just fine. So it may not be as robust at the JP Morgan Chases of the world as it had been in, say, 2021, but I think it's going to be better than people think.
And when we talk about what to expect from the banks, we could expect more provisioning, guys. Yesterday, we spoke with the IBM Vice Chairman Gary Cohn, who, of course, was at Goldman Sachs, on the sentiment of banks in the current economic environment. And this is what he had to say.
So banks are always concerned about additional regulatory costs, additional regulatory hurdles. And what does that mean? So holding more liquidity and holding more capital is always a good prophylactic against another regulatory move. Mm-hmm. So I would characterize banks right now in a relatively conservative mode.
Gillian, how is that going to translate to the provisioning from the banks and the commentary? Are we going to get sort of a flood of reassuring or attempts at reassuring from the banks as we start to hear from them tomorrow?
Well, I think one of the key questions people are going to be looking for is signs that the shock we had in March might be moving from an interest rate shock, which was quite different from what we saw in 2008. I mean, it really was a case of losses being caused by misjudging interest rate risk rather than credit risk. But the question we're looking at now is, are we moving into a credit risk problem as well, where essentially you're seeing corporate loans and consumer loans going into default, and whether the banks will be provisioning against that or not. Now, that obviously depends on the economy, but the chances are that we will see provisions for that rising quite notably, and they should rise quite notably, because there is a chance that particularly in sectors like commercial real estate, there's a lot of pain to come. The other question, of course, people will be looking at is, what kind of data do we get on deposit flight or deposit inflows? Because although we've had macro level data about how consumers have been moving from banks to money market funds and from small banks to larger banks, what we've not had is individual bank by bank breakdowns. So in many ways, the key question that investors will be looking for is evidence of what's actually been happening in terms of depositors moving their money in response to March's turmoil.
Jillian, just to follow on that, how long could credit risk particularly show up in a systemic type of stickiness, if you will, and really kind of from this perspective that is going to be one of the larger questions that we have to hear what banks are saying around that credit risk as well?
Well, how long is a piece of string? I mean, the honest answer is we just simply don't know. And it obviously depends a lot on what happens on the consumer side to inflation, to employment in particular. That's historically been one of the key drivers of consumer defaults, and the broader outlook for the economy. As far as the corporate sector is concerned, there are two really interesting questions here. One is that companies, for the most part, went into this whole period pretty cash rich. I mean, it's been a pretty good few years for companies in terms of their profit margins. That's the overall picture. But of course, you've got this very large tail of risky, troubled companies, the leveraged loan world, which are basically already displaying a lot of signs of real distress. Now, what's really interesting about the current cycle is that for the first time in history, you've had private capital play a really important role in the extraordinary bubble we saw between 2009 and 2022. And we simply don't know exactly how private capital is going to respond to a tightening of credit conditions and tightening of interest rate cycle. You know, in the past, we've had bubbles go pop, like in 2008. This time round, we may see more of a long, slow hiss as credit is impaired, but the signs of that aren't immediately obvious. Now, insofar as banks are exposed to that, because they're either funding the private capital vehicles or they're funding bridge loans for some of the private capital deals, that again could force a lot more provisioning going forward. But that's going to be slower and in many ways much harder to track, precisely because private capital is private and therefore more opaque.
And so as you're talking, Bill, to some of the executives at some of the banks here, kind of how are they viewing where we are in this crisis? And if indeed, as Jillian is talking about, are we moving into a credit risk phase, or are they sort of brushing off some of the concerns that are out there?
Well, you know, Jillian, of course, makes some very good points. I think that there's a couple of offsetting factors if you look again at the big Wall Street banks. One is, you know, they are in the moving business, not the storage business, Julie, and you know this. And so one of the bottlenecks has been that a number of leveraged deals that the banks committed to before April 2022, when the Fed started raising interest rates, were in a totally different interest rate environment. And they still have a number of those loans, including Twitter and Tenneco and some others on their books, totally billions of dollars that they're really having trouble moving off. They had to recently, last week, moved off the Citrix deal that had been hanging on there for a while and took a big hit, about $1.5 billion loss across the banking sector. If Twitter has to move, that could be a $6 billion loss, because those bonds, that debt is probably trading at around 50 cents on the dollar if you really were honest about it. So that is one big problem. The offset to that, of course, is that, you know, at the big banks where there's a flight to quality, they're paying basically still close to zero for their deposits. 1 basis point on checking, 2 basis points on a savings account at JP Morgan Chase. And they've got, $2.5 trillion of deposits, and they're able to put that in treasuries that are yielding a lot more than that, or in the deposits of other banks that are yielding a lot more than that. So they're making money just by pretty much doing nothing at the big safe banks. But they do have this overhang, not actually at JP Morgan Chase, interestingly enough, but at other banks, B of A and Barclays and Goldman Sachs have this overhang of loans that they made, leverage loans that they made in a different interest rate environment that they have to move off. So there's a lot of competing dynamics here, and that's what's going to make this earnings report this week so interesting.
Jillian, is there anything that the Fed could be listening into within the commentary of some of the bank execs, given the turmoil that had ensued mid-March, where it could change at least the discussion or the tenor of their discussions ahead of their next meeting? I think you may. Oh, there we go. We're starting to hear you now.
I think the Fed, like everyone else, is going to be looking very closely at the deposit data, although one hopes they have better information than most investors on that front. They'll be looking very carefully at the credit risk profiles that the banks are assuming. I mean, that's absolutely critical. And as Bill just said, very, very correctly and very smartly, and he knows this better than almost anybody else, the question of what's going to happen to all those hung bridges, all the financing the banks have provided for deals like Twitter will be absolutely crucial. And coming back to this issue about, the private capital questions, about all the financing deals financing they provided for deals. I mean, we're assuming there's going to be a slow burn, as a hiss, if you like, in the private capital sector as things get marked down. It's not also inconceivable that you might actually see, one big deal go pop or go badly wrong, and that would force the investors in private capital vehicles to demand a faster write-down, to demand more clarity. I think, again, the Fed will be very, very alert to that, and particularly alert to what's happening in the commercial real estate sector, which, of course, is on many people's radar as a real area of potential concern.
And finally, on a little bit of a different note, guys, Bill, your recent piece where you talked about Jamie Dimon, the Jamie and Janet show, as he went once again down to D.C. to try and work on this latest rescue, it got me thinking a little bit about his tenure at J.P. Morgan, for that matter, Brian Moynihan at Bank of America. Some of these bank CEOs have been around for a long time. And it made me wonder a little bit about when we might see a changing of the guard. Yes, Jane Fraser's newer at Citi, for example. But I do wonder when we're going to see that next phase, because these people are so entrenched and so really iconic at many of the banks. What's your thinking on that, Bill? And then, Jillian, I'm going to ask for your thinking on it as well.
Well, Julie, Charles de Gaulle once said that the graveyards are filled with indispensable men. So I know Jamie seems indispensable. Brian seems indispensable. James Gorman seems indispensable. At least, in Morgan Stanley, there's a clear succession program underway. It might be a few years, much cloudier at both Bank of America and at JP Morgan Chase. A lot of talent has left JP Morgan Chase waiting for Jamie Dimon to perhaps be selected Treasury Secretary to succeed Janet Yellen or to retire. It's a bank loaded with talent, but who it's going to be and when is a big open question. Bank of America, same thing. So succession is the most important thing that a CEO can do, Julie. And, Jamie Dimon and Brian Moynihan need to get it right.
Jillian, do you think that this is something that investors are paying enough attention to?
I think they certainly are, but it's been going on for such a long time that these conversations feel a bit like Groundhog Day. And to be honest, the entire crisis of March in some ways felt like Groundhog Day, because so many of the characters that Bill and I spoke to in 2008 and wrote about, are still there in some form. It's good because you do have a depth of experience. It's bad because actually, as and when they do move on, it's going to potentially create a bit of a shock. So I strongly agree with Bill that there needs to be more discussion about succession. And the fact that Jamie has not groomed visible successors who we've managed to keep in the stable is in some ways a black mark against his name. Now that could change. If we end up with a smooth succession in a few years' time, then suddenly historians really will deem him to have the crown of Wall Street in ways that he would very much like to have. But at the moment, it's a very open question about whether any succession will be smooth or not. And let us not forget just how critical JP Morgan is, because it's not just a question of Jamie going down to see Janet, it's a question of Jamie going down to see the three J's, Janet, Jay, and Jamie. And, he has a pivotal role in Wall Street, and people will be looking for him to show that he can build a path to the future, not just the past.
Yeah, good points all. Thank you both. Appreciate it. Don't think we're going to get anything on the succession front when we get earnings, but we'll keep an eye out for hints. The Financial Times' Gillian Tett, along with Bill Cohen, Puck News founding partner. Thanks to you both. Appreciate it. Good to see you again.
Thank you.
Thank you, Julie.
We got a trending ticker for you now. Progressive out with its latest quarterly results, reporting a 43% increase in first quarter earnings. Both net premiums written and earned rose in the latest quarter. However, EPS did miss analyst estimates, and the stock is down by more than 5.5% at this moment. It's actually one of the worst performers in the S&P 500 today. Coming up, Amazon touting optimism for the future despite a difficult year for big tech and for Amazon specifically. We're going to talk about the company's latest shareholder letter next.
I think the federal government did a reasonably good job of patching up the problem once it arose. Now, you could argue that they should have been on top of it before it arose, and the San Francisco Federal Reserve Board maybe should have been more closely monitoring Silicon Valley Bank. But on the whole, I think the U.S. government did a reasonably good job. They protected depositors. They did not protect creditors or shareholders. And I think in Washington today, it's very difficult to get enough political support to protect creditors and shareholders. It's easy to get support to protect depositors, though.
You talk to a lot of leaders. How do CEOs of these banks, how do they get in a situation like that?
Well, hindsight's always 20/20. I think in this case, Silicon Valley Bank was obviously growing very, very rapidly, and they had a business model that seemed to work, which is to lend money to venture capital firms and then require them to keep about 85% of the money in their bank. And then they put that money in treasury bills, which became worth less because as interest rates were going up, the bonds were going down in value. So they had a problem that maybe somebody should have picked up on earlier. But we don't have a contagion problem as much as we might have thought we were going to have. And clearly there are other banks that have some trouble now. I think First Republic Bank is clearly on a watch list, and probably somebody at some point will buy it. But the challenge there is it needs government assistance. There's a big hole in the balance sheet of First Republic Bank, I've been told, and therefore I suspect the government will have to provide some assistance if that deal is going to get done.
Is all of this over?
Is all of this over?
Turmoil.
Turmoil is never over as long as markets are open. There's always going to be somebody finding something wrong or somebody trying to do something that maybe they shouldn't do. So I think right now the worst of the turmoil for the banking sector in the United States, I think is probably behind us, but it'll be almost completely behind us when First Republic is resolved.
The world, according to Andy, not Jeff, Andy, Amazon CEO Andy Jassy out with his letter to shareholders defending the company's move to cut more than 27,000 jobs, shutter physical stores, and even citing what he calls short-term headwinds facing its key cloud computing unit, AWS. Here with more is Arun Sundaram, CFRA analyst who covers the stock. Arun, thanks for being here. What stood out to you from this letter? I just want to get your sort of big picture view first of all, as to kind of what stood out to you, what surprised you, what gave you some insight into what's going on at the company?
Yeah. I mean, I think overall the letter really confirmed our thoughts for 2023. As Andy Jassy said in the letter, the macro environment continues to be challenging, but really what Amazon is focused on is the controllables. That's really what they can do right now, and a lot of those controllables is about cutting costs, improving efficiencies, not just through layoffs, which probably the most publicized cost-cutting measure, but also trying to improve fulfillment speeds, lower the cost for fulfillment, improving delivery speeds. I think what was surprising maybe, though, to some investors is that, Amazon did continue to state that they will continue to invest in their business. They're still investing for the next pillar of growth, as they say, whether that's international expansion, the grocery space, healthcare, or even Project Kuiper, which is their low orbit satellite business that they're trying to roll out to bring broadband internet to underserved parts of the world. But these are big bets Amazon's making, and while not every big bet will turn out to be successful, it only takes one or two to really establish that next pillar of growth, which is what Amazon did back in the 2000s with AWS, and that turned out to be a successful investment.
Arun, even as you were reminding of the mention of Amazon saying within this letter, or Andy Jassy saying within this letter, that we're going to continue to invest in our business, it made me have the same natural reaction of like, all right, well, which one? Which one's going to receive the most investment? Is Amazon still a growth story for investors?
Yeah, certainly. We think Amazon's still, the growth story is still intact. Like I said, this year is really more on macro headwinds slowing the business. But once these macro headwinds abate, I think we'll see Amazon's growth reaccelerate. As Andy Jassy said in the shareholder letter, the two of the biggest opportunities in front of Amazon, it's still e-commerce and cloud computing. He reminded us that 80% of all global retail spending is still in physical stores, and that 90% of global IT spending is still on premise as opposed to the cloud. So as these equations flip, as he says, so should Amazon's growth, and that's still the two largest opportunities are still that e-commerce and cloud computing businesses. The rest, everything else is still those I bucket into those big bets bucket.
Yeah, definitely. And that stood out to me too when he talked about that hasn't reached its potential yet. Zeroing in on AWS for a second, some of what he said at AWS seemed to signal that maybe, like they have classically done in the retail business, maybe they're going to give up a little bit on the margins, right? Talking about that they're keeping the eye on long-term growth, helping their clients with cost optimization. Did you read that way? What was your takeaway from that AWS commentary?
Yeah, no, that commentary was consistent, with what Andy Jassy and Amazon's been saying for a few quarters now. AWS isn't going to grow in that really attractive 30% growth rate that we've been seeing over the past few years. especially now that the macro environment is slowing. We see AWS growing in the mid-teen percentage range this year, which is still good, but it is a pretty significant deceleration from that 30% clip that it's been running at. But like I said before, Amazon's really working or trying to focus on the controllables. So they are going to its customers and trying to lower costs for its customers. The good news is that Amazon isn't losing AWS customers. Instead, it's working with its existing customers to try to lower their costs. So that's going to have an impact on their top line as well as margins. But right now, Amazon's really focused on developing those relationships with its customers, these long-term relationships, so that they continue to stick around and continue to use AWS. That's why we believe once this macro environment improves, I think we'll start to see AWS growth re-accelerate. Typically, once we exit these kind of macro downturns, that's typically when you see more cloud adoption. And like I said before, cloud adoption is still very much under-penetrated. And so I think as we exit this economic downturn, we'll start to see cloud adoption re-accelerate.
Yeah, and during downturns or during weak periods, that's typically when companies like Amazon, with more cash to throw around, invest in some of the next legs of growth for them. And particularly, you brought up Project Kuiper, so I just want to go in that direction. Is it viable to think of Amazon as a competitor or a major player in the communication services or the connectivity landscape?
I think it's still a long shot, but again, this is another big bet they are making. These low orbit satellites. The goal is to bring broadband internet to different parts of the world. That's not only going to help consumers around the world, but it's also going to help Amazon. They need better infrastructure in certain countries in order to even introduce their e-commerce business there, or even introduce AWS in certain parts of the country. So it's really a win-win situation. But they're still very much in the early stages of these kind of businesses. Like I said, some of these bets end up working, some of them don't. But all it takes is really one big successful investment to really establish that next pillar of growth for Amazon.
Just lastly, while we have you, Arun, Alibaba, of course, breaking up its division for far different, or its business into different divisions for far different reasons as well. But for Amazon, would they benefit from offloading or at least spinning off certain parts of their business into their own entities, at least while they are big bets? Or on the other side of that, because it is a stable business and it could be a standalone by itself?
I mean, AWS could certainly be a standalone business, but I don't see Amazon spinning off that business. The AWS really does complement Amazon's other businesses. It complements their e-commerce business. It actually complements their advertising business. They're allowed to integrate AWS into their marketing and advertising platform to help advertisers on Amazon. So, and it's really that that AWS is the strongest pillar of growth right now for the company as well. So I think they'll continue to keep that business intact.
Fair. All right, Arun Sundaram, who is the CFRA analyst, joining us here to talk all things Amazon and Andy Jassy's letter. Really exciting analysis. We appreciate it here. Arun, thanks so much.
Thank you.
Thanks. Coming up, buckle up. Praz and Rick, they're going to join us after test driving Toyota's new Corolla. We've got that next.
Crypto investors have weathered through a volatile market this past year. And if you're one of them, there are a few rules you should know regarding taking losses on your tax return. And here are our top 3 tips. The first is you can deduct up to $3,000 of your capital losses against your ordinary income. What this means is if you have a net capital loss during the year, you can use $3,000 of it and offset your ordinary income, such as salary and wages. And you might ask, what if you have more than $3,000? And that brings us to our tip number 2, and that is please document and track any capital losses because you can indefinitely bring them forward. So if you have extra capital losses, you can always bring them next year to offset any future capital gains, or you can always take the $3,000 ordinary losses. Our last but not least tip, experts recommend that if you had a cryptocurrency that imploded in value or went bankrupt, you can always try to sell it for 0.1% of a cent just to claim that capital loss. And the reason is because the worthless security law around crypto is extremely unclear. So this is a workaround to help you claim your losses.
It is likely that electric vehicles will become the majority of cars driven in the United States at some point in the future, but that doesn't mean manual transmission cars will become a thing of the past. Yahoo Finance's Pras Subramanian and Rick Newman got a chance to check out Toyota's new Corolla. They join us now. Okay, so Pras, tell us what's there to like here.
Yeah, so this isn't your standard Corolla, right? They took this car that Akio Toyoda, the chairman of Toyota, said, hey, I want to make an enthusiast car for the U.S. market, just for the U.S. market. So he took a regular Corolla, added a manual transmission, a race-inspired 3-cylinder, 300 horsepower engine, all-wheel drive. And I think, Rick, in my opinion, I think it's such a fantastic package, and it's $40,000. So I think it really is a testament to showing what Toyota can do when they want to sort of address a certain market. And before EVs take over the world, this is your last chance to get a really kind of an enthusiast car, which I think for a decent price.
Yeah, that's right. I mean, you can always buy a Porsche, right, for $100,000 or something. Exactly. But even at that level, I mean, so I think if this car came out 10 years ago, I don't think it would have intrigued us the way it does, and it's because nobody builds manual transmission cars anymore. I mean, they're hard to find. They're not as efficient as they used to be compared with automatics. And of course, everything's now going to electric vehicles. I remember when I was interviewing the president of GM once, when one of the new Corvettes was coming out, and I asked him off camera, will there be a manual transmission? And he nodded his head and he said no, because nobody buys it.
That's
the reason. He said nobody buys it.
Like, who wants this?
Well,
Can you drive a manual transmission?
No.
I can't drive a manual transmission.
We'll teach you guys.
I'm
good. Why though?
We showed a graph there that actually a lot of younger buyers are actually seeking them out, and the take rate
for nostalgia.
Yes. Like that's for the same reason they like vinyl record. Yes, it's like vinyl records.
Analog experience.
That's right.
And they're showing that there's a take rate is climbing recently for manual transmissions. So there is something. I think Toyota is also maybe they see that trend becoming a thing now. Maybe.
I mean, how many of these things are they going to sell?
I mean, it's going to be a low volume, but you know, I mean, they're doing it, for word of mouth, such as we're getting right here. But I think here's the thing with manual transmissions. I mean, this is where driving came from, right? I mean, this takes you all the way back to what cars were like when they first hit the road. You had to make the gears move on your own, and there's just something that's sort of fundamental. I mean, they're much better, obviously, but you are more connected to the car. You're more connected to the road. I only have one car, and it is a manual transmission Subaru, which was hard to find. I went out of my way to find it and wait for it. And my attitude with that car is I'm just going to hold on to that until it won't run anymore, because you're not going to be able to buy these things.
And I just want to quickly add, driving that car, reviewing the car actually, was a fantastic go-kart type experience, very sporty.
Go-kart.
Because it's small and it's powerful and it makes the right sounds, triple exhaust, everything like that.
Makes the right
all-wheel drive. But I want to say though, for the future, future for making it easier. There's
We're having a culture clash here. These guys don't get car culture.
There's an interactive button
is
there
easy.
that allows it for shifting easier, rev matching. So there's a way to kind of ease people into it. It's not as hard as we would think it would be in this day and age.
Who was the better driver of the manual?
I'm always the better driver. You guys don't want to drive with Praz. It's a little nerve-wracking.
With Praz, he's a good driver in a manual EV.
Not in this car.
Or in a automatic EV, I should say.
I don't think a manual EV exists.
Yeah, no, that should not
yet.
No, there makes no sense because there are no gears.
Not yet.
I have to say, this reminds me of one of my greatest pet peeves as a driver, and I have many, especially in New Jersey. When you're in the Holland Tunnel and I don't know if somebody's shifting gears when you get like the huge engine sound and you're in the tunnel and you're like jump out of your skin as you're trying to stay in that tiny lane. Was it you?
It's a lot of fun to really rev it up in a tunnel, yeah.
Don't do that. Please don't do that.
When you're going 3 miles per hour.
Yeah.
I would call that unnecessary.
Yes, I would call it rude.
I mean, it's Jersey, so what do you want? What do you want?
Wow, okay, thanks a lot, guys. All right. You can read the full review, by the way, on yahoofinance.com of that new cool card. Coming up, Lael Brainerd has some thoughts on the banks, and they are not in line with the thoughts of Treasury Secretary Janet Yellen. We'll talk about that next. Collapse of Silicon Valley Bank and Signature Bank sent the banking industry into a tailspin. Many investors are now weighing the recent bank run's impact on banks' ability to lend money, with the expectation that a credit crunch could tip the U.S. into recession, or at least be a contributor. Treasury Secretary Janet Yellen and Fed officials are not seeing much in the way of credit risk, but the head of President Biden's Economic Council says otherwise. We also talked to Jillian Chet just a bit ago of the FT, and she highlighted that risk. Yahoo Finance's Jennifer Schonberger has been watching this debate. What can you tell us, Jen?
Good morning, Julie. Banks are showing some signs of pulling back a bit on credit, says Lael Brainerd, President Biden's new director of the National Economic Council and former vice chair of the Federal Reserve. Brainerd made comments in an interview on CNN, and those come as Fed officials have said they expect credit conditions to tighten in the wake of Silicon Valley Bank's failure. Though Brainerd said overall, the financial stresses stemming from those failures seem to be easing. Brainerd's comments contrast with Treasury Secretary Janet Yellen's this week, who told reporters that she really hasn't seen evidence at this stage that suggests a contraction in credit, though she said it's still a possibility. New York Fed President John Williams similarly told me in an exclusive interview Tuesday that he's not seeing broader impacts on consumer and business spending from credit tightening, though it's still early days. But Brainerd, for her part, may be onto something. According to the New York Fed's latest survey of consumer expectations, a greater share of households said it was harder to get a loan in March than a year ago, as well as any other month since the survey of consumer expectations started in 2013. Consumers also think it will be harder to get a loan a year from now. Now, in another sign that banks could be poised to cut back on lending, tiny $84 million market cap Bank of South Carolina said in their earnings press release Thursday that, quote, "We are behind in our profit plan for the first 3 months of this year. This outcome is the result of precipitous increases in our deposit costs to meet the intense competition amongst banks, brokerages, and the U.S. Treasury. Although loan interest income has increased, our margins remain thin." Now, Fed minutes revealed Wednesday that Fed staff, that's different than Fed officials, members of the Fed, see a mild recession taking hold later this year as a result of reverberations from those bank failures. Asked about this on CNN, Brainerd simply said that banks across the board are working to shore up their balance sheet. The White House was also asked about this earlier this morning in Ireland, and White House press secretary pushed back, saying that recent economic indicators are not consistent with a recession or even a pre-recession. Julie?
All right, I'll take it from here. Yahoo Finance's own Jennifer Schonberger. Thanks so much, Jennifer, for breaking that down. Appreciate it. Guys, coming up, the state of venture capital, how the startup space is faring following the collapse of Silicon Valley Bank. We've got more on that next. Finding and funding the future. It's been a slow start to the year in venture capital deals with bank defaults, still high inflation, and an uncertain economic environment forcing startups to be more realistic about their growth prospects and pushing funders to be more choosy about what they invest in. So let's learn more about 2023 in deals. Don Butler, Managing Director of Tomvest Ventures, and Kyle Stanford, PitchBook Senior Analyst, joining us here today. Thanks so much for the time, guys.
Pleasure to be here.
First and foremost, Don, when we think about the holistic environment that we're in right now and the appetite for deal making, what are you hearing among VCs?
Well, I think, it's something like the appetite is there, but the ability is not necessarily there right now. I think what you're seeing is a lot of firms are triaging the portfolios that they have today. And then I think as we've been coming through that wave, the next thing they're doing is I think they're also triaging their own funds. And, in this sort of uncertain environment, what we're starting to see is funds looking out and saying, well, gosh, I might have been pacing myself too quickly. And if I need to slow down my pace to get more vintage years, that's going to slow everything down. And at the same time, if I've got my eyes towards raising my next fund, I've got to think about what are the assets that I save to do that. And then secondly, on my own team, like on my own venture team, who's going to go with me for the next fundraise? And so we're seeing a lot of kind of two waves of triage happening in the funding environment.
Yeah, and the triage is reflected in the numbers we were just talking about, which is from a report that you guys came out with on the first quarter, sort of state of VC right now. Things don't seem great. I guess the headline number or the headline for that. But what sort of stood out to you as you guys were piecing through the numbers as particularly acute areas, or is it just everything?
I mean, really everything. But when we look at what's probably most important for the venture market, that low amount of exit value that's being generated is going to cause problems down the road. Right? We have a huge number of unicorns. We have a huge number of companies that have raised these high valuations in 2020 and 2021, but are unable to get liquidity, and they're also not finding the funding they need. These companies are large, relatively well developed. They need huge amounts of capital, and that's not there right now. We huge pullback from the hedge funds and mutual funds, and they are really pushed a lot of money into the market right now. And so these companies at the late stage with no exit market are really sitting in a tough position.
What type of companies are we talking about that are still getting funding, even in this environment? There's been a lot of talk about what health tech, the future of healthcare could look like with a new infusion of technology, or even on the generative AI front because of all of the artificial intelligence resurgence in the chat, if you will.
Yeah, right. Well, so what the investors have done is really changed where they're putting the premium or what they're valuing these companies right now. It's no longer just a sheer revenue growth, like let's see how big we can get this market share. It's how can you create a business that has solid fundamentals, getting close to profitability, right? Profitability is something that's thrown on all the time. It's not necessarily what VC is made on, because you have to be growing, but you also have to have relatively low CACs. You have to be able to bring in more money than what you are. Bringing in more money than what it's costing you to put that product out there. And that's not what venture has been doing the past few years.
Right, that is a big change.
So the companies that are able to show those strong metrics and strong fundamentals are getting the capital right now.
Yeah, I mean, we've seen a lot of cutting at the publicly traded companies, right? We've seen job cuts, we've seen expense cuts of all kinds. Don, is that something that you all are pushing your portfolio companies to do as well? Are we seeing it a lot on the private side?
We are on the private side, but I'd say really there was a first round of cuts that happened last year, and what we're getting is we're sort of getting people's homework graded on did they cut enough, and are they able to push their unit economics in a direction that sort of tells you either one of two things: either I'm going to drive to break even, or I'm going to drive my overall burn down so much that when I need to do that next fundraise, the next fundraise is not 100 million, it's 25 million, or it's some smaller number that can be managed. That's what we're really seeing in terms of the first wave of layoffs. And then the second thing that we're seeing is some firms are coming back and saying, I didn't cut enough. And so we have seen a second round of layoffs among certain startups, especially, what I find is it tends to be the ones we've seen, tends to be the later stage ones because they had such large headcount. If you have a 30, 40 person Series A company and you cut 10 people, you've already, there's not much more to do. Right. Yeah. And so I think what you'll see in terms of headlines going forward will probably be more oriented around those bigger companies that maybe didn't cut enough. Because I remember people thinking, well, it'll be Q1 2023 is when the market will come back. And that shifted to, well, maybe Q3, maybe Q4 of this year, maybe next year. So I think the the duration of this downturn is much longer than people were initially projecting.
Are we seeing a major shift in terms of the regionality of where these dollars are flowing? Previously, it was, hey, if it's a startup in Silicon Valley, of course we got to look at them, we got to hear the pitch, and we have to at least kick the tires on this. Has that shifted elsewhere in the U.S. now?
Sadly, as someone whose office is right in South Park in San Francisco, I think it has. I think it started to. I think your numbers also showed sort of a shift down from San Francisco. There's still this great hub, and one thing I think I particularly enjoy when we're out there in the city or in the Bay Area is you can throw a rock and hit somebody in the tech ecosystem. Like the amount of just happenstance that leads to people being hired or meeting new customers or investors is something that I don't know if you replicate in other territories. I've had friends who've moved to Miami who say, a lot of people I meet here, don't exactly know what venture is or how the venture ecosystem works. So I think there's still quite a bit of dynamism there, but still go to downtown San Francisco on a Tuesday afternoon and you'll notice traffic is way down.
Yeah, we got to leave it there, guys. I wish we could talk much more about all this stuff. Thanks for coming in. Really appreciate it. Don Butler, Managing Director at Tom Vest Ventures, and Kyle Stanford, PitchBook Senior Analyst of VC. Thanks. Coming up, tax day fast approaching, but why is the U.S. tax law so complicated? We'll talk about it next. Tax day, we've been counting it down. If you're keeping track, it's now less than a week away. If you're sweating your 1040s and your 1099s, remember this. In Estonia, it takes less than 5 minutes to file your taxes, and it's free. Oh, that makes me feel a lot better. Thank you very much. Here's Yahoo Finance's Rebecca Chen on why the U.S. tax system is so complicated as part of our ultimate tax guide. Why is it so complicated, Rebecca?
So let's start off with some statistics. In America, the average taxpayer takes about 13 hours to do their tax return, and they pay about $240 for tax prep fees. And if they have a question for the IRS, it takes them about 22 minutes to wait online, and that's if they get through. In 2021, 2022, I think studies show that only 10% of callers got through to the IRS.
Oh my gosh.
So, and that kind of brings us to why our tax system is so complicated and why is it sort of not very friendly to taxpayers. And it's really because our tax system is trying to do more than just collect taxes. It's trying to it has a progressive system, and they're trying to distribute social welfare. They're trying to encourage certain social agendas. For example, Congress wants us to save for the retirement. So you have the you have the deduction for IRA contribution, and they want us to become homeowners. So you have the mortgage interest rate deduction. So the reason why it's so complicated is really because the system is more than just collecting taxes. It's a system that's used for a political agenda, not political agenda, but Congress's agenda for what they believe the society should look like.
Interesting. I've been looking up flights to Estonia as well, since you mentioned it at the top. It's only $300.
Rebecca, thanks so much. Appreciate it. We got to leave it there. Coming up, Rochelle Akufo is going to continue our coverage of tax day with a panel of experts on some last-minute tips. Did we mention it's less than a week till tax day?
Less than a week.
All right. Have a great day, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West Coast. I'm Ines Ferre in for Rochelle Akufo. Here's what I'm watching. The great disconnect. Markets fight over the Fed over rates as the White House pushes back on the central bank's recession warning. Is anyone on the same page? We get into that debate. Also guiding higher, Delta offers a bullish outlook for the summer travel season, but is it strong demand or limited flight capacity that's giving them a tailwind? We'll hear more from CEO Ed Bastian. And social trading, eToro looks to benefit from Twitter users by the investment community. They strike a partnership that pushes Elon Musk's company into the financial realm. We get all the details this hour, but first, let's take a look at the major averages. You're looking at the Dow, that's up 127 points. The S&P 500 is up 0.6%. The Nasdaq up more than 1%, up the most out of the major averages, up 153 points. And taking a look at Treasury yields, we are watching yields moving slightly lower. You've got the 10-year yield that is at 3.41% and the 5-year yield at 3.46%. Mind the gap. The disconnect between what the Fed is signaling versus what markets expect it to do is creating a volatile backdrop amid ongoing concern that the financial stability risks have not entirely subsided. The immediate shock may have passed, but experts say more gloom is to come. Here's what so-called Dr. Doom Nouriel Roubini had to say yesterday.
The worst is still ahead of us. The business model of many regional banks is broken. They have a narrow deposit base. They have a large amount of uninsured deposits. that massive losses on their securities. Even the value of their loans is falling. They have exposure to commercial real estate. And many of them, if you measure it correctly, given the changes in interest rates, are now insolvent.
So if banks aren't yet in the clear, how much danger is the wider economy in? Here with more, Marta Norton, Morningstar Wealth Chief Investment Officer, America's Marta, thanks so much for joining us. We have bank earnings kicking off tomorrow. It's the regionals that are going to be closely watched. We've seen a drawdown in their stocks. You're saying proceed with caution when it comes to this space. Is there further risk on the horizon given the recent bank turmoil?
And Ness, I think there's no question that we're in a period of pretty great uncertainty. If we look back to past crises of a similar ilk. Now, you could look at the great financial crisis, you could look at the savings and loan crisis, but one of the things that you observe from these periods is that they're slow moving, that they're rolling over time. And so while I think there's a big temptation to call any sort of crisis over and done as soon as the initial panic subsides, I think there's always reason to have kind of a bound of uncertainty around those types of calls and leave some room for the possibility that we could see more turmoil to come. So I think that's what we, and I think a lot of other investors are going to be watching as we see bank earnings come out in the next week or so.
And the Fed minutes earlier this week showed that the Federal Reserve is expecting a mild recession. You've got the White House that's pushing back, that's saying there's no recession on the horizon. We just saw jobless claims coming in a little bit higher than expected last week. So we have seen a little bit of a slowdown when it comes to the jobs market. It's still, though, a tight jobs market. Are you expecting the Fed to continue with at least a 25 basis point rate hike at its next meeting? And what is this going to do for the markets?
I think we're reaching a point where there's greater uncertainty as to what the Fed is going to do next. That said, the Fed has pushed back time and time again against an assumption that rate hikes were coming to an end. So we saw that, some concern or expectation, better said, that the Fed was going to stop raising rates when we hit peak inflation, that the Fed was going to stop raising rates when we saw that financial instability. And the Fed has continued to push into its effort to keep inflation under control. And so there's, I think, a reasonable expectation to expect at least one more rate hike in the cards. That said, I do like to put those bounds of uncertainty around things because we really are reaching a point where there's one variable after another that we're having to balance against one another.
So then how should investors position their portfolios?
Listen, what we're thinking about as we take a look at markets globally, both equities and fixed income, is that valuations are certainly improved relative to a year or so ago, but we have seen a tremendous rally. So when you're looking at the equity markets, despite, the financial instability that we're seeing, the U.S. equity market, the global equity market has done reasonably well to date, and there's still a lot of uncertainty out there. So while generally speaking, we think valuations are certainly better, long-term return prospects are certainly better than they were a few years ago, I think a bit of caution is warranted. So we're looking at things like cash and short-term bonds. We're looking at areas like consumer staples and healthcare, and we have that exposure in our portfolio to provide some sort of ballast if we see volatility creep up.
What about emerging markets?
Yeah, so emerging market valuations are looking a lot better. Now, there's this economic risk that's obviously going to impact emerging markets as well. But we see areas like China as actually a pretty attractive area, and we've seen a tremendous rally there. We also see areas like Brazil as looking pretty attractive, especially given the yield that we see from Brazilian equities. So I think those are areas of opportunity, no question, but they're not going to be necessarily protective in the event of a global economic slowdown. So you have to balance that valuation argument against the macroeconomic concerns.
You mentioned cash, more in cash. How much more are we talking about? I mean, how do you divvy up the portfolio?
Right. So it's more on the margin, I would say, that we're increasing cash. Most of our portfolios are still pretty fully invested. Some of that fully invested portfolio is in short dated bonds, which has obviously protective characteristics. But what we're looking at is you kind of think of it almost like a laddered portfolio. We have some maybe modestly more cash by a few percentage points relative to what we would normally have. We have these safer equities like healthcare, like consumer staples. And then we have areas that are far more opportunistic when you're thinking about China, Brazil, even some areas of like European financials, European energy that still look relatively attractive to us. So it's really going across that entire risk spectrum, predicated on valuation.
Big thanks to Mark Norton, Morningstar Wealth Chief Investment Officer Americas. Thanks so much for joining us. And Twitter is moving into the financial services business. The social media giant announcing a cash-tagged partnership with the Israel-based online brokerage and crypto trading platform eToro. Beginning Thursday, Twitter users will be able to see real-time prices for a much wider range of stocks, crypto, and other assets. They'll also have the option to invest on the platform through eToro. Here to discuss is eToro U.S. investment analyst Callie Cox. Callie, thanks so much for joining us. So how is this going to work? So do you scroll over a cash tag? Let's say it's cash tag BBBY. Then do you see the market action on that, and then you can click on to go to eToro?
Yeah, so I think you have it right, Inez. It's really as simple as it sounds. We have cash tags on Twitter, which, you know, for those who don't know, cash tags are the little $ and then the ticker in front of them. You hover over it, you're able to click on it. You can see a price chart of the ticker that you're clicking on, and then you can head to eToro's platform and actually engage in the investing part of it. You can buy, sell any of the stocks that you hover over, and you can join our community and talk further with other investors and possibly invested in those stocks or interested in those stocks.
Do you have any data on conversion rates when you do this? Because, I mean, we just heard Elon Musk saying in an interview recently that usage is at all-time highs for Twitter. So do you have any data as to how many people would actually click on that and then go to eToro and then open up an account?
Well, look, so we all know that people go to Twitter for their financial news. I think Twitter has proven that over and over again throughout the years. And cash tags are really the connection point for that. I know that eToro, of course, has over 30 million registered users, and Twitter has thousands of cash tags and millions of users as well. So while we don't have conversion rates at the moment, we just launched today, we're very optimistic that this could be a collaborative partnership.
And how significant is social media when it comes to investing? I mean, we have seen the rise of social media. We've seen the rise of also influencers on social media, financial influencers. How much do you lean on social media for investing?
Well, I'm a little biased. I work for a social investing app, and that's what eToro is. We believe in the power of community, and our real bread and butter is getting everybody together in one place and getting all the instruments that they want to trade and just letting the magic happen from there. So we believe in the power of social investing. We believe in the power of how community can really boost confidence and help people feel more educated as they step into investing. And personally, I've been a user of Twitter for years now, about 10 years. And you know, I work for eToro, so I'm a big proponent for social investing as well.
And as far as educating, I mean, you just mentioned that educating the public, but when it comes to social media, it's also brief. So how do you go about that? Like, what are some of the challenges when it comes to educating the public about their financial investments, but in a very brief way?
So that's a really good question. And I think you have to balance the power of community with the risks that can come with, you know, possibly getting caught up in the tides. And I think every investor needs to be aware of that too. Investing is an inherently personal exercise. You have to remember your own goals first and foremost, and your own why for investing, because ultimately it's your money. That being said, I think community can be really powerful, but at the same time, you can't let that escalate into falling into groupthink like many other things in life. You really have to look out for yourself first.
And we've seen a lot of volatility when it comes to the markets. We've seen volatility when it comes to equities, when it comes to crypto. We also have seen that there's been more and more market participants talking about also a recession, a possible recession. So given that backdrop, what is the strategy for getting investors to invest more during a volatile time at the cusp of what could be a recession?
Well, let me tell you, investors have been incredibly resilient over these past 2 years. We actually keep our finger on the pulse of the American retail investor. We do quarterly surveys along with other one-off surveys just to see what they're thinking about, what they're worried about, and what they're investing in. And their investing levels and confidence are still quite high. I attribute that to the fact that the American consumer is doing quite well right now. And when you have money, you're more inclined to invest it. So obviously the mood is a little more pessimistic at the moment, and we've seen retail investors get more nervous, but we're really trying to encourage them to, again, focus on their why and focus on their goals, because a lot of retail investors are long-term investors that have a strategic lean in this environment. They diversify, they look at single stocks here and there, but they also are investing for long-term security and retirement. So we're just encouraging them here. We're providing them the tools and education they need to feel empowered in this moment. And we're letting them know too, I mean, the classic investing advice is buy low, sell high. So this could be an opportunity for you if you're able to keep your financial house in order.
Buy low, sell high. Callie Cox, eToro U.S. investment analyst. Thanks so much for joining us. And coming up, bank results are always critical, but after the biggest failure since 2007, they take on a slightly different significance. We talk expectations and a growing divide over the fallout for credit. More on that next. Stay with us. Banking sector results take on a different significance this quarter as the investment community still reels from the collapse of SVB. JP Morgan, Wells Fargo, and Citi are first out of the gate tomorrow. Former Goldman Sachs COO Gary Cohen gave us his take on the situation yesterday. Take a listen.
Lending conditions in the banking community are changing and changing quite rapidly. We've seen a lot of deposits move around the system. We've seen deposits move from small regional banks to larger banks, and then we've seen deposits move out of larger banks into money markets and treasury funds. So there's less money in the system to be lent out. Once banks have to hold their excess reserves, they can lend the remaining balances. But the remaining balances today at banks are relatively low. So the banks themselves are contracting the economy. The Federal Reserve Board understands that. I think they're trying to understand what the magnitude of that is.
And credit availability causing some debate in recent days. Treasury Secretary Janet Yellen this week said she'd seen no evidence of contraction in credit following the bank's failures. A different tone being struck by National Economic Council President Lael Brainerd in an interview with CNN. Earnings per share for the 6 largest banks in the U.S. is likely to slump around 10% from last year. That's according to estimates from Refinitiv. Our next guest says the biggest issue for banks will be their outlook, as deposit flows have taken center stage amid the recent banking turmoil. Let's bring in Nathan Stovall, S&P Global Market Intelligence Director for Financial Institutions Research. Nathan, thanks so much for joining us. So what will you be looking for with earnings that are kicking off tomorrow, and how significant are deposit outflows risks going forward?
Well, it's definitely significant, and it really is the number one issue. And what we're going to be looking for is what happened in the first quarter, but also what bank management teams say about what has happened since then. Because remember, they're watching these flows on a daily basis. And so we're going to look at how do deposit balances square against some of the data we've seen from the Fed, which shows that deposits have declined about 3% year to date. But as Gary Cohn said, we've seen stronger performance from the large institutions who've seen those declines around 2%, whereas banks out of the top 25 have seen declines around 4%. And the reason why that matters is exactly as he illustrated. It constrains their ability to lend. And so far, they have pulled back a little bit. We haven't seen severe constriction in credit. But if that picks up, that is deflationary. That is deleveraging in the economy, and that could lead to a little bit of a slowdown. But the real issue is going to be that banks are defending the cash that they have and defending it with higher rates on the deposit products they offer. So we're going to want to hear from bank management teams, how aggressively are they going after their depositors? What kind of rates are they having to offer to maintain the balances they have, keep the customers they have? Because the spread between bank deposit rates and the money markets has never been this wide. And we think that that's going to narrow. That's one of the reasons why you see analysts expecting earnings to be down 10% year over year in Q1. And we think that number is actually going to be even larger throughout the year as those costs continue to grind higher throughout 23.
Right. So do they have any option besides increasing their yields on deposits? So, I mean, because why would somebody keep a deposit in a bank if they can get a better yield elsewhere? I mean, what recourse do they have?
Well, there's other reasons why people bank with a given bank beyond just yield. Now, there's no doubt about it that is a determinant in many customers' minds. But what other services is the bank offering? If I'm a commercial customer, am I offering treasury and cash management products? If I'm a retail customer, do I like the access to the digital services they offer, whether that's a mobile banking app, whether that's branch convenience? Do I have lending products with them, and as a result, they waive certain fees? So banks have other ways to retain and attract customers. And that's one of the reasons why they've been able to lag the increase in rates we saw last year so much year to date. But liquidity pressures were already building early this year. The 2 large bank failures we saw in March and the liquidity crunch that followed definitely accelerated that. So it is putting more pressure on them to raise those deposit rates. And one thing we've seen is while we've seen outflows broadly in deposit products, we've seen CDs, higher rate products, grow at a much, much faster clip. They're up about 20% year to date. And we think that sort of mix shift will continue. And that'll be another big story of Q1 earnings.
Are you expecting to see a sort of big divide between what the big banks report and then what the smaller regional banks show? I mean, are we expecting the big banks to be the winners here?
I think you're going to see a couple of things. And yes, I do think you'll see a divide. I think the Fed data illustrates that the big banks have held up better, and they've seen a little bit of a benefit from call it to a flight to safety. So I think we'll see a little bit difference in terms of the way that they talk about their deposit business. But also they're going to be talking about what's happening in their investment banking business, which is a little bit different. The regionals, I think you're going to see some separation there in terms of haves and have-nots. Some companies that have been under more pressure, some banks have been able to maintain their business. And I think you're going to see some who haven't seen as much change, but have kind of been painted with the same broad brush. And then when you go down smaller, you could see kind of the same dynamic, where we've talked to a lot of community banks across the country who have said it's more business as usual for them. So one of the interesting things here is I think you're going to end up with a very different view of individual institutions post Q1. Because so far, yes, you have seen some underperformers and some modest outperformers, but largely the investment community has looked at the whole group with kind of a sense of fear. And this is going to provide us with a lot more insight into who has really come under greater pressure and who has been able to mitigate that pressure and kind of maintain business as usual.
And are we going to get any glimpse on lending standards? Have they gotten tighter, and have they gotten tighter within the regionals? Have the big banks also tightened their lending standards? I mean, are we seeing the impact of what has happened?
Yes, I think we will hear about that, and we have already seen that lending standards have tightened over the last few quarters. The Fed Senior Loan Officer Survey has said that on pretty much all lending products. That is going to be a big topic during Q1 earnings calls. No doubt about that, as well as the outlook for the economy and the prospect of a recession on the horizon. You know, most of the big banks had already baked in the prospect of a mild recession, not anything really severe. But one of the things that's interesting about this is while we've had this kind of liquidity crunch, the underlying economy has remained pretty strong. So the investment community is going to want to hear details on the health of the underlying borrowing base. I think banks will tighten standards. I think that they're going to be a little bit more careful with each dollar that they lend out. But investors are really going to want to hear greater detail on areas of concern, how those borrowing bases are holding up, and particularly around certain segments like commercial real estate, and within that, things like office.
And we saw what happened with regional stocks since the beginning of the year. They're still down year to date pretty heavily, double-digit percentages. Are we going to see M&A behavior among some of these regional banks?
I think eventually we'll get there. I mean, there's some headwinds to that around regulation, and I think people are going to wait for more detail on what new regulations could come as a result of this. You know, we think there's going to be more focus on deposit concentrations, deposit composition. Historically, it's been most on the loan side, so there'll be some changes there. But I think once the dust sort of settles and we get a little bit more clarity, the institutions that are more stretched from a liquidity perspective, I think will be much more motivated to look to partner with other institutions, while those who are a little bit more stable, I think absolutely could look at it as a way to sort of diversify maybe their lending base and perhaps even acquire somebody on the cheap. Right now, bank M&A activity is at historical lows, and I do think it'll pick up. But it's not going to accelerate in a big way really soon. But back half of the year, get a little bit more clarity on regulations, funding, and the economy. I think you will see some more transaction activity.
Nathan Stovall, S&P Global Market Intelligence Director for Financial Institutions Research. Thanks so much for joining us.
Thank you.
And coming up, Delta misses the street on first quarter results, but CEO Ed Bastian sounding confident on the airline's 2023 guidance, and shareholders seem to believe him. We dive into that story next.
We've hired over the last couple of years, between 3,000 and 4,000 pilots. So we largely are where we need to be. We continue to hire, I'd say now more at a normal attrition level compared to pre-pandemic levels. The challenge we have at the moment is we need to get all the new pilots trained, and we have a fixed number of training devices. We're doing well this summer coming up. We are minimizing the training. We've got most of our big training events already behind us, and we'll be able to put more and more pilots into the operation, which gives us the ability to
that
fly a
was
bigger schedule.
Delta CEO Ed Bastian. While Delta may be curtailing its hiring spree, it seems there is a short runway to get pilots trained up ahead of the summer travel season. With airline earnings underway, we welcome TD Cowen Senior Research Analyst Helene Becker for more on what to expect from the current quarter as airlines navigate ongoing demand and infrastructure challenges. Helene, thanks so much for joining us. So what did you make of Delta's results and their outlook?
Thanks for having me. So I think the outlook was more important than the actual results for the first quarter. People forget that the first quarter is the worst of the year. And this year, January and February, were still not as good as they've been in prior Januaries and Februaries. And I think part of it was the early MLK holiday. I think people had just come back from traveling and were maybe needed a rest. I think travel picked up in mid-February, and it definitely picked up over the last 4 weeks. We're about equal to where we were in 2019. And so I think the first quarter was actually wound up being in line with what we were expecting, but we were lower than consensus. And for the second quarter, we expect very strong results. We expect what I've said to our sales force and our clients is that we think we're going to see record or near record revenues for second and third quarter. Whether we have record earnings remains to be seen, given that we have higher fuel costs, higher labor costs, higher maintenance costs, training costs. And so costs are going to weigh on the industry, but revenues are up a lot. And I think that will carry the day for at least the second and third quarters.
And speaking of costs, American Airlines warned that their first quarter profit is going to be short of estimates, and because of high costs. So what are the high costs that are most concerning to you? Is it jet fuel? Is it labor costs?
Yes, it was both. So labor costs have gone up significantly. There's been a combination of two things that have happened. One, you had a lot of retirements, and you had a lot of people taking not so much redundancy programs, but taking leaves of absences during the pandemic and just never came back to the industry. So you've had a huge increase in hiring over the last year and a half. And actually, you played that clip from Ed where he talked about that. What that means is, as you think about people gaining another year of experience, another year and a half of experience, you're going to see productivity improvements. And so that labor cost, even though the absolute dollars are going up, the average should go down because you have people with less seniority. So that should be a benefit. Fuel is going to remain volatile, and the industry in general doesn't hedge. And I don't see that changing. They've never really gotten hedging right, so they just don't do it. And they adjust ticket prices to account for higher or lower fuel prices. Maintenance costs are up because of OEM delivery delays. The OEMs, Airbus, Boeing, and others are having issues getting with their supply chain. And so there's been a delay in the number of aircraft that they're delivering. They are not back to their pre-pandemic production levels. And so that means think about CapEx moving to the right, there being fewer seats available. The FAA asked the 4 biggest airlines serving the New York market specifically to cut capacity by 10% this summer. We're already down 10% from where we were 4 years ago, and you've got demand that's equal to where we were. So that says to me, fares have only one way to go, and that's up. And we should see some margin improvement, but we're definitely going to get record revenue.
Despite the concerns about a recession, I mean, Delta's saying basically, look, we're going to see strong demand, even if people are talking about a recession. I mean, how recession-proof is this? Are we? What do you see happening if there is a recession later this year?
That's such a great question because with airlines, you never see the downturn coming because they're such a lagging indicator. So we're worried. I'm worried about the fourth quarter, I would say, because I expect, as I said, strong third and second quarter demand. But fourth quarter, I think people may be traveled out. I think the hybrid work environment is abating a little bit. Managements, bosses want their people back in the office. There's only so many times you can take your kiddos out of school to go on long weekends. So I think as you think about moving further and further away from the pandemic, I think you get fewer and fewer of these what we call bleisure trips that combine business and leisure. And to your point, I think the fourth quarter will show some of that weakness. The Fed seems to be trying to engineer higher unemployment. Personal balance sheets are experiencing the impact of slower wage growth, higher fuel cost, and we're coming out of the heating season into the air conditioning season. Those costs have gone up. Food costs have gone up significantly. So as people think about what they want to spend their money on, yes, experiences for the summer, but then they have to rebuild their personal balance sheets. And so I think as you go into the next recession, the industry isn't recession proof. I know a lot of my colleagues thought that would be the case in the last decade, and it turned out not to be. I don't think it will ever be recession proof because it's so economically dependent, and I don't see that changing, frankly.
TD Cowen Senior Research Analyst Helene Becker, thanks so much for joining us. Coming up.
Thanks for having me.
A finance professor says ChatGPT might be able to predict stock moves. Are we getting ahead of ourselves here? He joins us after the break.
Crypto investors have weathered through a volatile market this past year. And if you're one of them, there are a few rules you should know regarding taking losses on your tax return. And here are our top 3 tips. The first is you can deduct up to $3,000 of your capital losses against your ordinary income. What this means is if you have a net capital loss during the year, you can use $3,000 of it and offset your ordinary income, such as salary and wages. And you might ask, what if you have more than $3,000? And that brings us to our tip number 2, and that is please document and track any capital losses because you can indefinitely bring them forward. So if you have extra capital losses, you can always bring them next year to offset any future capital gains, or you can always take the $3,000 ordinary losses. Our last but not least tip, experts recommend that if you had a cryptocurrency that imploded in value or went bankrupt, you can always try to sell it for 0.1% of a cent just to claim that capital loss. And the reason is because the worthless security law around crypto is extremely unclear. So this is a workaround to help you claim your losses.
Reaching 100 million users 2 months after its launch, according to analysts. While many may have used this AI chatbot to generate text prompts such as articles or job applications, our next guest says ChatGPT may be able to forecast stock price movements. Here with more on this is the co-author of this report, Alejandra Lopez-Lira, University of Florida, Warrington College of Business Assistant Professor. Alejandra, thanks for joining us. Tell us, what did you find? How accurate were these AI-generated predictions?
Hi, yes, thank you for having me. So what we're doing is we're trying to understand whether ChatGPT can accurately forecast returns based on news headlines. As you can imagine, there's a lot of financial information in the news headlines, and well, a lot of analysts are hired to understand those. So we thought a fun experiment would be to ask, what happens if we ask ChatGPT based on a headline, is this going to be good for the stock price of the company, or is this going to be bad for the stock price of the company? Right. What we do find is that there's some statistical significance associated. So, OpenAI ChatGPT predicts better than would be expected by chance.
So it's based on headlines. So you don't look necessarily on charts. You don't look necessarily on the fundamentals. It's based on headlines of articles that are written about these, correct?
Yes, correct. And one reason we do it is because the numerical capabilities of ChatGPT are not there yet with the other software that you would use for numerical analysis. So ChatGPT's strength is using the textual information.
Because so much of investing is really, some invest based on chart analysis, some invest based on the fundamentals. There's also an emotional component to this. I mean, I guess the question is, when we're talking about ChatGPT and predicting stock moves, does it take the emotional part out? You're basically saying it really depends on what's said about that stock.
Yes, actually, we think one of the advantages of ChatGPT relative to just counting the number of words is precisely that it can understand the context. So it can take a little bit more into account what the sentiment of the headline is trying to convey, precisely because it's trained on, past newspapers, past internet exchanges, etc. So it kind of like is able to grasp this more subtle parts of the language relative to other off-the-shelf software.
So where do you go next with this type of study? Are you looking at other ways of studying how AI can predict stock market moves?
Yeah, definitely. So all of my research is mostly done in the area of artificial intelligence. Past papers have shown, for example, that other types of algorithms can predict earnings better than what you would see on average for the analyst forecast. And the big question is like, how far can we take it? We obviously understand the limitations of ChatGPT. We know it's not able to accurately process large numbers of data points. It's mostly just a relevant piece of text. So one question would be, what if we just try to put some summaries of say the company's earnings were up to by 30% and the average earnings up is like 5%. Would that make it have better forecasts if we give it more contextual information, or would it be the same?
And you mentioned analysts. I mean, does this change sort of what does this put in jeopardy the analyst's job or the analyst analysis? How does artificial intelligence and predictions correlate with what analysts are saying or what portfolio managers are doing?
Yeah, so it will definitely increase the productivity of analysts in the first place, right? If you have a big technology that's able to help you calculate thousands of headlines and just tell you what the expected result is going to be, it's probably going to make the job so much easier. So I would definitely be expecting a lot of investment professionals to incorporate this kind of artificial intelligence tools into their analysis. The quicker they incorporate it, we would expect that the predictability of the returns actually declines, right? Markets will become more efficient. As soon as everyone is using ChatGPT to predict returns, then there will be no more predictability because the market will incorporate the information fairly quickly. I also want to mention quickly that, for example, most of the predictability is concentrated in smaller stocks because the market prices more accurately larger stocks. So it's just hard to trade on news based on that.
Oh, interesting. So it's better success rates with the smaller cap stocks?
Yes, and that's a pervasive phenomenon that we just observe whenever you're trying to predict stock returns or kind of like similar market movements. Smaller stocks are easier to predict. That's where the predictability is concentrated. That's also because these smaller stocks are sometimes more costly to trade. So in some sense, some investment professionals may not consider it worth it to go through the transaction costs.
It'll be interesting to see how all of this artificial intelligence and stock investing develops. Thanks so much, Alejandro Lopez-Lira, University of Florida, Warrington College of Business Assistant Professor. Thanks for joining us. And coming up, your ultimate tax guide continues, the countdown to deadline day. Next, we'll take a closer look at how you can avoid some of the many scams out there. Don't miss it. There's only a few days left to get your taxes filed before the April 18th deadline, and the Yahoo Finance Ultimate Tax Guide has you covered with last-minute tips. Joining me now is Robert Powell, Finstream.tv co-founder, and Jeff Levine, Buckingham Strategic Wealth Chief Planning Officer. Ahead of the filing, Jeff, what should taxpayers keep in mind when it comes to contributions, let's say?
Sure. I mean, we have a limited amount of time left to make those last-minute contributions to potentially reduce your 2022 tax liability. Now, of course, we're more than 3 months into 2023 already, so there isn't a ton you can do now to lower last year's tax liability. But among those things remains deductible IRA contributions, which can be made up till the filing deadline. Remains HSA contributions if you were enrolled in a high deductible HSA eligible plan last year. If you're a business owner making contributions to a SEP IRA or a profit sharing plan, a similar type of plan. And then finally, the ability for certain business owners to make certain tax elections like accelerated depreciation. All of that can be done now, today, to reduce your tax liability for last year.
Robert, some may wonder, hey, why is my tax refund not the same as it was the year before? What are some of the reasons why maybe there's a little bit of shock when you do your taxes and you find out that Uncle Sam isn't giving you as much back?
There could be a couple reasons. One is the fact that maybe you earned more income, and because of the way the tax code works, the liability that you paid throughout the year is far greater, and the amount that you'll be getting in return is far less. The other is that you may have gone into your employee benefit department at the start of the year and changed your withholding to accommodate what you thought was going to happen, and that number that you readjusted your withholding to probably was different. The outcome was different than what you would have expected.
Jeff, what about tax credits like a child credit?
Yeah, these are things that can change from one year to the next. For instance, you may have a child that gets too old to qualify for the child tax credit, or you may have a child that gets too old to qualify for the dependent and care credit. So credits are dollar for dollar reductions in your tax liability. So if you lose out on a credit in 1 year versus the last, it can have a much more impactful change on your ultimate tax liability than, say, being phased out of a deduction, because again, the credits are a dollar for dollar reduction in your taxes.
And Robert, as far as a refund or perhaps if you owe this year, what are some ways that may be unexpected to increase your refund or to decrease the amount that you owe the government?
Well, I think many people are just subject to the standard deduction now. So the ability to accelerate income or accelerate deductions or bunch deductions is limited to maybe 5% of taxpayers. So the ability to sort of increase your refund or reduce it really is a matter of adjusting your withholding with your employee benefit department. And I'd say if the one last thing I might mention too is if you're having trouble getting your tax return done, you can file for an extension, but you should go through all the processes to find out what you do owe Uncle Sam and pay that amount by tax day. Otherwise, you'll be subject to penalties.
So aren't you essentially, though, doing your refunds because you have to figure out how much you're going to owe?
You're doing
it. I mean, it's like kind of like back of the envelope kind of calculations. Okay, here you go. This is how much I owe.
Mm-hmm. Yes, I mean, you could face if you've underpaid, you'll have an underpayment penalty. It may not be a lot for some people, but it could be a lot for others too, especially folks who might be self-employed, where they maybe failed to pay a quarterly tax payment, or they didn't quite figure out the formula for paying their quarterly tax payments.
But Robert, just one quick note on this extension, though. You know, my feeling has always been, oh, if you extend, you're going to raise a red flag to the IRS to audit you later on. Is that completely unfounded, or is there something to that?
I think if you're a typical W-2 wage earner, that if you file for an extension, you have nothing to worry about. If, on the other hand, you're filing and you have a very complicated return, you own multiple LLCs, you have various deductions that can be challenged, then you probably could be raising a red flag. But I think for most average people who are filing an extension, they have nothing to worry about.
And Jeff, some people moved out of state last year during the pandemic. I mean, how significant is it that you have to file correctly within the state that you are now residing in? What should people watch out for?
There's a lot there to think about, because you not only have to worry about where you are today, but also where you were part of, let's say, last year. You might have to file a multi-state return, which can bring all sorts of nuances into it. And a lot of time people think like, hey, I spent 180 days plus in this new place, therefore I don't have to worry about this old place. And that's not true. One of the things that trips a lot of people up is there's this term called domicile. And domicile is effectively a nebulous type of thing where it's the place that you intend to effectively return one day. And so sometimes a state may consider you domiciled in your current location, even if you spent most of the year in another place, and that can lead you to file taxes again in multiple states. You end up in most cases paying the higher of the two state taxes for a lot of these things. So it definitely increases the complexity of the return. And you want to make sure, one thing is absolutely critical, is that if you pay taxes to one state, oftentimes another state will give you a credit for those taxes paid. Not all, but a lot of times there's a credit available, and you don't want to miss that credit because it can be quite a bit of money, especially for higher earning taxpayers.
A lot to think about for this tax season. Thanks so much. With just a few days to go, guys. Thank you to Robert Powell, Finstream.tv co-founder, and Jeffrey Levine, Buckingham Strategic Wealth Chief Planning Officer. And continuing our tax coverage, the IRS released its 2023 Dirty Dozen roundup of tax scams and schemes to watch out for. This year, here with some tips on avoiding fraud is Yahoo Finance's Ali Garfunkel. Ali?
Hi, Inez. So fraud is a particular problem during tax season, and there are kind of a couple of reasons why, but I think the key one is that we don't all have a lot of experience dealing with the IRS. So we don't necessarily know, for instance, how they'll be in touch. It's also an incredibly stressful time that I think scammers are likely to spend time trying to exploit when they can. And we know for a fact that this is true because the numbers back it up. For instance, in 2022 alone, the IRS identified $5.7 billion in tax fraud, and they're expecting an even higher number this year. So I think it's worth walking through what some of kind of the key scams that we're likely to see are. The first is, you're going to hear is, we've all talked about phishing emails, I feel like, but phishing emails are absolutely a tax-related scam that we'll see. A lot of the time what they will be asking is to verify your information. However, it is unlikely the IRS will send you an email, and scammers will pretend to be the IRS in that email and can lead you even to a page that looks like an IRS website. But it is not the IRS, it is a phishing email. The second one to consider is, remember, tax returns are often filed online. I believe it's more than 90% of tax returns that are filed online. So the other one to consider is that taxes being filed under your name is something that could happen, even if you didn't do it. Now, this is actually much more common than you might think. It was surprising to me because last year, in 2022, there were 7.8 million reports of tax-related suspicious activity tied to identity theft. And the last one is one that we've all gotten a robocall. You can get a tax robocall demanding money. That is something that the IRS will never, ever do. So that's something to be aware of. So there's a lot, I've gone through a lot of things about like what you can't do, but what can you do, right? And I think that's important to talk about too. And I think there are a lot of best practices. In general, I personally recommend identity monitoring, fraud protection. I have all of those things personally. The other thing is there are certain things that scammers will do that you can identify when you get, for instance, a phishing email. For example, if someone's claiming your social security number has been revoked or canceled, that is impossible. That never happens. If you get an email or a call saying your social security number is canceled, it is a scam. Next, in emails, check the from line. Now, what does that mean? You know the part at the top of the email where it says, okay, this is who the email's from? Hover your cursor over that name and check the email address. If it is not from a .gov email address, it is very likely a scam. And last, don't trust caller ID. This is really hard for me. I trust caller ID very, very staunchly. But the reality is caller ID can also be faked. There are frequently a lot of robocalls out there, worlds of thousands of robocalls that can call you and demand money for taxes. So don't trust your caller ID. I realize this is a lot of information, but the bottom line is be aware and don't let the stress of tax season make you more vulnerable to just clicking something because you're afraid or worried that you owe money that you don't owe yet.
And just remember, the IRS won't ever call you, so you have
it will occasionally. It's very rare, but it does happen. But they will try to get in touch with you via email first.
Okay, thanks so much.
Mail,
Allie.
snail mail.
That is snail mail, not email, snail mail.
Snail mail, not emails. I'm just so used to talking about email.
Thanks, Allie Garfinkel. And we are wrapping up the week's Ultimate Tax Guide tomorrow with Kathy Pickering, HR Block Chief Tax Officer. She's got all the tips you need to start planning for next year's taxes. You won't want to miss it. Brian Sozzi sat down this week with the Carlyle Group co-founder David Rubenstein for a wide-ranging interview. Take a listen to what he had to say on the banking crisis.
I think the federal government did a reasonably good job of patching up the problem once it arose. Now, you could argue that they should have been on top of it before it arose, and the San Francisco Federal Reserve Board maybe should have been more closely monitoring Silicon Valley Bank. But on the whole, I think the U.S. government did a reasonably good job. They protected depositors. They did not protect creditors or shareholders. And I think in Washington today, it's very difficult to get enough political support to protect creditors and shareholders. It's easy to get support to protect depositors, though.
You talk to a lot of leaders. How do CEOs of these banks, how do they get in a situation like that?
Well, hindsight's always 20/20. I think in this case, Silicon Valley Bank was obviously growing very, very rapidly, and they had a business model that seemed to work, which is to lend money to venture capital firms and then require them to keep about 85% of the money in their bank, and then they put that money in treasury bills, which became worth less because as interest rates were going up, the bonds were going down in value. So they had a problem that maybe somebody should have picked up on earlier. But we don't have a contagion problem as much as we might have thought we were going to have. And clearly there are other banks that have some trouble now. I think First Republic Bank is clearly on a watch list, and probably somebody at some point will buy it. But the challenge there is it needs government assistance. There's a big hole in the balance sheet of First Republic Bank, I've been told, and therefore I suspect the government will have to provide some assistance if that deal is going to get done.
Is all of this over?
Is all of this over?
Turmoil.
Turmoil is never over as long as markets are open. There's always going to be somebody finding something wrong or somebody trying to do something that maybe they shouldn't do. So I think right now the worst of the turmoil for the banking sector in the United States, I think is probably behind us, but it'll be almost completely behind us when First Republic is resolved.
Brian Sozzi sat down this week with the Carlyle Group co-founder David Rubenstein for a wide-ranging interview. They discussed the current state of the private equity market, the overall stock market, the economy, the direction of interest rates, and Rubenstein's new television series. The full interview publishes this Friday morning. Let's do a final check of the markets right now. We are looking at the Dow that's up almost 0.5%, up 160 points. The S&P 500 up 0.6%, up 27 points. The Nasdaq is the big outperformer today, up 1.4% or 166 points. That's it for me. I'm Ines Ferre. Thanks for watching.